unprecedented energy crisis, the need for transformative solutions has never been more urgent. But within crisis lies opportunity. Welcome to the second annual Tribeca Future-Facing Commodities Conference, held in the heart of Singapore. Over the next 3 days challenges, we're diving deep into solutions, beginning with the technologies and resources that will pave the way to a carbon-neutral future. This is where the leaders of today shape the energy landscape of tomorrow. Invest, innovate and inspire. Together, we will discover unparalleled investment opportunities for the energy transition and connect with like-minded professionals committed to making a difference. The future is not just what happens to create. Welcome to the second annual Tribeca Future-Facing Commodities Conference. Well, good morning, everyone. Lovely to have you in the room with us. Those of you early birds who've gotten up nice and brightly this morning, I hope you're enjoying everything that Singapore is turning on for us, especially those of you that have travelled from quite some distance. Good morning, fellas. Come in and grab a seat. So, slightly intimate gathering this morning. Mr. Bairstow, as you come to this stage. Hello, Tom. Nice to see you, sir, and lovely to have those of you who are joining us online as well for the second day of our conference yet. My name is Christina, and it is my great honour to be your MC over the next couple of days as we learn together. And also some educational matter will be shared with us today and some panels. The first presentation this morning is in fact educational, and I could have done with a bit of help. Excited last year, I don't know, like many of you probably all had your 10-bagger or two. I got my very first 10-bagger last year in battery minerals, and I was absolutely went up, and then it just went boom and crashed. And I've had a chat with our first presenter about that, and he said, Gernot, did you not realise that when it goes up there, you're supposed to jump out? I was a bit of a virgin at that one. I was just in there for the ride. And he said, no, get out. This morning's presentation is going to have a little bit of a look at for battery minerals and what that's done to share prices. So how it's changed the landscape of the market. And leading us through this discussion, as I've mentioned, is Hayden Bairstow. Now, Hayden has a very impressive reputation. He was originally with Macquarie, wasn't it, for quite some time, and now he's with that giant Argonaut, and he's got a very impressive reputation with Argonaut. I could go through it. He's actually with Argonaut's research division. He's what we call in Australia an influential individual in this particular field. So we're really looking forward to hearing from him this morning. Would you please welcome from Argonaut to discuss the volatility in the commodity price for battery minerals this morning, Mr. Hayden Bairstow.
Thanks, Chrissy, and morning all, and well done on getting up early. It's always a bit of a challenge, I know. Especially being in the equity markets in Perth, where we, for some reason, don't have daylight savings. So if you're working in a place like Macquarie, then the morning meeting is about 7:30 Sydney time, and if you take 3 hours off that, you can work out what time you have to get up every morning. So well done. It's certainly not that early, but we'll get kicking on this. So what I thought I'd do today and sort of just go through what the battery materials market's done in the Aussie market, and obviously there's 50 companies here presenting over the 3 days. And just to provide a little bit of a landscape for where those companies are, where they've been, and sort of what this whole battery materials market has done to the landscape in the ASX in particular. So this is not a great chart, but it's basically everyone who's presenting this year and how they've gone over the last 12 months. And as you can see, it's been pretty tough. I did have to remove Mr. Rivera from this chart because when he's up 1,000%, it sort of skews the axis a fair bit. But certainly the uranium places, names have been quite good. There's some good development plays there, but I think it shows you that if you make a discovery that's material it doesn't matter what the commodity price is doing in reality, that you'll just get a lot of value. But if you're sort of working on an asset that's understood, then you do become beholden to what's actually happening in the shorter term on some of these commodity prices. So it has been a tough 12 months, but if we move forward to what's happened in 2024, it's starting to get a little bit better. The access is certainly shrinking. I mean, these numbers are still plenty of companies in negative territory this year, as there's been a pretty strong sell-off in the first quarter, but we are seeing a little bit of glimmer of hope there. I mean, I think the stronger performance from last year, particularly in the uranium space, that sector's been continued to be strong, and NexGen continues to advance its project, and it's helped them be one of the better players. But we are starting to see, a bit of a broader recovery across a number of different areas through base metals as well, which has been quite encouraging. And then when we look at the last month, it's starting to look better. So obviously coming off a fairly low base here, but we're getting momentum across the whole sector now. There's plenty of things that are now up and up pretty reasonably in the last sort of 3 or 4 weeks. 2/3 of the companies here are all up. So certainly encouraged by all of that. And particularly the breadth, I think. It's not just lithium going up or base metals, it's a bit of everything. It's rare earths are going up. We're seeing a decent recovery across the board. And I think as a couple of presenters yesterday indicated, lithium prices particularly have probably bottomed. We saw Albemarle overnight with a decent spot price sale. So those sort of negative momentum stories are slowing, and in fact have turned to the positive. And similar for the copper space. I think the outlook on copper particularly, and I think Scott touched on that yesterday, the ability for the world to make enough copper to actually undertake this entire decarbonisation of the global power grid is going to be quite challenging. And that will flow through to most of these battery materials in our view. So when we look to the commodity prices, I mean, this is the chart on the left is sort of where I always like to point people to. I mean, in general, these commodity prices they do benefit from inflation. Obviously, it's pretty skewed by what's happened with uranium prices and the low they came off. But most commodity prices, through a cycle are generally pretty heading in the right direction. I mean, you can start with gold prices, which just track inflation, and they generally just go up every year on average once you smooth normal month-by-month volatility. But certainly these battery materials names, if you're up sort of 50, 60% over a 5-year period, I mean, it's a pretty good return if you can roll that into the equities, particularly when you think about anyone who's producing a commodity generally has 2 to 3 times leverage to that move. So you're going to start seeing some pretty significant moves in value. Obviously, the chart on the right, though, just highlights that it has been pretty tough in the short term, and that's the reason that a lot of companies have struggled, is we've just had this negative momentum across a lot of the battery material space, particularly in lithium in the last year. So that's been the sort of, I guess, hit a peak. So we're sort of at the peak this time last year almost. So we were coming off what was extraordinary pricing through the back end of 22. And hence the percentage numbers look quite aggressive, but in reality, coming off that low, and we'll start moving forward, I think we're going to start seeing a much more bullish outlook across all of these battery materials. And what will start to emerge, I think, is really the supply difficulties. Mining these things, developing them, getting approvals across the globe in different countries is far more difficult than anyone ever anticipates. I've been looking at commodities for over 20 years, and I hark back to 2010, 2011 when the world decided that iron ore was finished because BHP, Rio and Vale were adding tonnes in Australia, and none of them hit any of their targets. And these companies are basically unlimited on funding, and they still couldn't do it. And we had a bull run in iron ore for a decade, which is still going now because the supply just never arrived. So to think that we can do the same in some of these smaller, more difficult metallurgical commodities like things like spodumene and lithium and rare earths and these sorts of things, and actually deliver on targets is arguably farcical in my view. So I think that we're going to see an ongoing story of just supply disappointment pushing markets into deficits, and we'll just see continued price spikes and more volatility in this space as we try and increase the scale of these markets. I mean, if you look at anyone's targets for EVs and battery storage, I mean, the lithium market needs to quadruple inside of a decade. I mean, it's just, I don't know, it's going to be pretty hard to do. So it would just create a lot of volatility as expectations move around from being oversupplied for a very short period of time to supply deficits, as we've seen in the past in plenty of other commodities. So we look in the very short term. Again, the start of the year been pretty tough, but if you look at the last month, as I suggested, sort of everything's starting to go up pretty much. So it's looking quite encouraging that we're starting to see some decent moves across the board. So certainly to suggest we've come off the bottom, I think that chart on the right would just demonstrate to you that we are off the bottom effectively, and it's all looking quite encouraging. I think there's a few laggards there on the right-hand side, but rare earth still heavily controlled by China in terms of supply. They're probably the bigger laggard, I think, out of most of this space. And obviously, uranium and iron ore have had such a good year last year that it doesn't surprise anyone really. They've ticked back a little bit, but when you look at the share price chart, or the chart for those commodities, it's a blip to the downside more than anything else. So yeah, certainly encouraging signs across the board. So what I thought I'd do, looking at the Aussie market, obviously the lithium space has sort of come out of nowhere. If you look back a decade, these companies barely existed. I mean, Min Resources was a mining services and iron ore business, but between the four bigger ones, they've certainly become quite large players. The market caps have soared to sort of peaked at over 50 billion combined between the three of them. And probably the interesting thing is, as you can see, they ran with the lithium price really hard. But the biggest intriguing thing, and as we get through some of these other slides in comparison, is that the market at the big end has been happy to look through the lithium price fall and the trough that it's hit and now come out of. Min Resources is a little bit different because it does have a big iron ore business, and that's obviously been a massive benefactor for them. But in reality, Pilbara is just pure lithium, and IGO is pretty much the same, to be honest. And they've also really held up reasonably well in comparison to what we've seen in the commodity price. So when you think about big long-only funds in Australia that struggle to put money to work at the best of times, they're happy to hold big positions in these names, thinking they'll look through it on a 3 to 5 year view, and implies that the lithium prices are heading back to somewhere in that 20 to 30,000 range based on where the share prices currently are at the moment. So that's pretty much what you need to plug in to get the current share prices in terms of evaluation for a lot of these bigger stocks. So that's where I think the broader market still prices lithium in the longer term. But when we look beyond some of these bigger ones and look at some of the smaller ones, I mean, lithium's a little bit different because we had Tony at Azura and obviously Liontown sort of emerge out of nowhere really and make amazing discoveries through 2023. Liontown obviously had the bid from Albemarle that came and then went, but they were building a pretty sizable project themselves. So the next leg, I guess, of the bigger players in lithium in that top chart just shows you that it became a pretty sizable business. But those stocks, I mean, Liontown's obviously come off with the bid as well, but they've come back with the lithium price. If I strip out anything involved in corporate M&A and just look at the other three bigger players in Patriot, Wildcat and Latin, then they have suffered a bit, but again, nowhere near as much as some of the smaller names, which I'll get to in a second, but haven't quite held up as well as some of the bigger names. I mean, Patriot would probably be the exception to that, and given the quality of and this potential scale of that project in Quebec, it does not surprise me at all. I think just again a demonstration, as we saw with Azure, that if you make, as I said at the beginning, a real discovery of a scalable asset, you will essentially become commodity price agnostic. It'll just be a question of going through the process, which is 3 to 5 to 7 years, depending on where your asset is, to develop it up, put resources around it, put a structure around how it's going to get into production, and just go through that process. And if it's attractive enough, like we've seen with Azure, then you just get taken over by a bigger player and they put it in their portfolio and go and do it themselves. So I think from a volatility point of view, it's always been my sort of view is if you're in the bigger names or the assets that have got real scale, if there is periods of weakness on commodity price moves or market weakness, etc., on Patriot share price there at the bottom in grey is a good example. They're the entry point opportunities because the asset is still there. And it is essentially a commodity price agnostic outcome. Patriot's asset will get built no matter what the lithium price is, pretty much. It's just a question of time frame and how long it takes to get there. But when we look at some of the smaller names, this is where they have gone down with the lithium price. And we look at the tops, all the small spodumene guys in Oz and in Canada, with Piedmont and Sayona with their operating asset, Core, which got into production and has now turned off again, and then some of the smaller guys. They found it much tougher, and we haven't really seen a material recovery yet. And that, I think, is partly because it's not a huge institutional basis, so we're not seeing that longer term view of I just need to put money to work, I'm getting inflows every day, so I'm just going to hold a sizable position in, say, a Pilbara or Mineral Resources. It's probably a little bit more what you'd call hot money and retail money. So as the commodity prices fall and sort of the exit from these companies has been quite aggressive. More so on the bottom ones, which is the brine names, where they've all really struggled across the board in terms of where they were. And obviously, you know, looking at the market caps of these things, they were up at sort of $5-6 billion at one point last year when lithium prices were $70,000-$80,000 a tonne. But yeah, have also struggled. And a little bit of that was, I guess, there's hype in the sector at the time, and it was just sort of get into anything in lithium and it was all going up. And there's been a little bit of a reset of expectations as to how long and technically difficult some of these projects might be, or if it's at smaller scale at a lower price environment, then you're going to need to do a joint venture deal with someone who's got infrastructure or something like that, which starts to shift the economics around a little bit. So these are the names that obviously, if the lithium prices start heading back to anything like where they were, will probably do the best, given where they are. But you do need that lithium price to continue to recover. If it stayed where it is for today, for example, for the year, I think it would still be a reasonably tough environment for a lot of these share prices for the next 12 months. But certainly if Chrissy looking for another 10 bagger, you're probably going to find it in something of this ilk as opposed to buying Pilbara at the top end, because those names are already quite well valued as opposed to some of these smaller names. We look across parts of the battery materials space. The nickel space has just been totally transformed in Australia. I mean, we had IGO as a nickel company for a while, who's now Lithium. Western Areas got taken over by IGO. Mincor got taken over by Andrew Forrest, Wiley Metals. So we've been left with basically, we just had Chalice and developing its project and Nickel Mines. And Nickel Mines is obviously the dominant player. And one of the reasons the nickel price is as weak as it is, because they're a participant in the Indonesian capacity build out in NPI, which has flooded the nickel market and pushed the price down as much as it has. So yeah, there's not a lot of options now in the Aussie space in terms of things that are in production. They've all sort of disappeared out of the market. You've literally either got Nickel Mines or you have to move to IGO, which is essentially a lithium company. So Nickel Mines is basically the only game in town from a producing point of view at this point in time. But there are some development players out there that I still think have a lot of promise. You look at Centaurus in Brazil, has held value okay. I mean, it's come under a fair bit of pressure like most of them. And Chalice Mining, which Alex has been speaking here, or I think yesterday, you know, it's a bit of a mixed bag. It's not just nickel, it's PGMs primarily as well, which have a similar share price chart, to be honest, in terms of the nickel price. So yeah, those big scale assets like that, you just have to continue to push through and develop it. And at some point, the market will recognise that there is a pathway to production that's fundable by themselves, and you'll start seeing a better outcome. So yeah, the smaller scale things have really been the ones that have struggled the most for mine. So if you are looking for high risk, high return type outcomes, then I'd certainly be pointing you towards these sort of spaces as opposed to the bigger names, which remain quite solid. And I'll just finish on, I guess, a bit more of a positive note, which is the sectors that have just had a really good couple of years. I mean, gold's obviously not in the battery materials space in any real way, but it's a huge part of the Aussie market. We've had a big merger in Australia as well with Newmont and Newcrest, but it's now pushed the whole market cap over 100 billion. So as you can see, in terms of the importance in the Australian market, gold does dominate and does take, I think, away some of the equity interest in some of the battery materials space when things are weak as they are today, because the gold price has just hit new highs almost every day over the course of the last couple of years. So the gold sector is broad as well. There's sort of at least 20 odd producers in Australia, so there's a huge list that you can pick from and provides a lot more interest in the space. And then the other area has been uranium, which has been nothing short of extraordinary. I mean, the market cap of this space is sort of approaching some of the lithium, mid-cap lithiums and gone beyond them. So it's become something that no one really looked at all 3 or 4 years ago to becoming quite material. And there's no sign of it slowing at the moment. I mean, obviously, uranium is heavily reliant on government policy in terms of nuclear build-out. But at this point, there's a lot of supply risk around where it comes from, particularly historically, the amount of production we got out of places like Kazakhstan. So it does look like a quite an encouraging sort of mini sector that's emerging in the Aussie space that will, I think, continue to get more and more interest, particularly as some of these guys get back into production. Boss has basically just started, Paladin's on the cusp, NexGen's clearly got the biggest and best asset, but it's a few years away from being in production. But we'll start getting a few of these guys actually producing and starting to demonstrate how much money they can make out of actually producing uranium as well, which I think will bring even more focus to the whole market. So volatility's there. It's hard. How do you deal with it? Well, I mean, your friendly Argonaut research team puts out a lot of notes trying to help you navigate what's actually going on. There's 4 of us in the mining space, based out of Perth. We've got an institutional sales desk in Perth and in Sydney. I think George from Sydney is here at the conference this week, who have a lot of close contact. The advantage of being in Perth, as we are, is that one of us is out of the office on the terrace or up in West Perth seeing a management team pretty regularly, to be honest. So getting that face-to-face contact as you're all getting at this conference is something that we do on a fairly regular basis. So if you are struggling with volatility, there's plenty of guys from Argonaut that will be happy to give you a hand to try and navigate it. And with that, I'll leave it there.
Thank you very much, Hayden. I genuinely could have listened to that for a lot longer. And a reminder that we do put those talks up on our YouTube channel. Anyone have a question? Because he's got 3 minutes up his sleeve. Stuart, is there anything from the floor you'd like to ask? All right, you can go and speak to him more intimately in his booth, which is just inside the door on the left-hand side in the exhibition hall. Thank you very much for that.
Thanks, Chris.
And I'm thinking I should have punted uranium last year. Would have perhaps been a better bet, but there you go. All right. Oh, wait. Wait 1 second. We do have a couple of seconds up our sleeve.
People always ask me that. And again, a lot of that comes to your tolerance on risk, right? I mean, it's my number one pick in terms of what I think is the safest company to own would be something like Mineral Resources, but it's not going to go up 100%. 50% or more. Jeez. Good question.
Are we giving personal stock recommendations?
I don't know.
Think so.
Yeah, I don't think so. I can't think of things that go that much.
He's doing broad observations today. Thanks so much, Hayden.
Yeah.
Cheers.
Thanks, guys.
All right. Some good news for our first company to take to the stage this morning. So you've got Galan Lithium written down in front of you. There is an announcement, and I've been reading it in the last hour or two, that's come to light. It's about a sizable increase in its mineral resources estimate for the Hombre Muerto West project, which is located in Argentina. And that makes it its highest grade resource estimate declared in Argentina to date. So very impressive. So this fellow's going to have a smile on his step as he comes up to join us. So what does that mean, of course, for Galan's resource base, its ability to react to any of those lithium price upswings that we're looking for? This is their MD for Galan. This is JP Vargas de la Vega. Please make him very welcome.
Good morning, and it's a bit cold in here, isn't it? Yeah, I never thought that I would say that here in Singapore. Well, thanks very much for attending the conference. It's a pleasure to be once again in Singapore. And just looking back, just 12 months ago when the conference kicked on, and I remember presenting here, there's a lot to tell about Galan in the last 12 months, and I would like to say there's a lot more to tell in the next 12 months' time coming up. So, with the usual disclosure, I will take you into a bit of a memory lane about Galan. This is Galan in 2019, just before COVID, before the world turned upside down. We managed to drill at Hombre Muerto West, and we didn't know what we were going into. The only thing that we knew that we were next to Livent, called Arcadium today, and we will see what we'll have at the time. Well, fast forward 5 years, or less than 5 years actually, and this is yesterday. So we are going through our phase 1 development. You see the ponds being constructed. You see that pond number 1 is already being filled. Pond number 2 is started being filled as well. And what you can see in black are the liners being laid down. We expect to finish the laying of liners for pond number 2 in the next 10 days or 2 weeks, and no longer than that. Pond number 3, just next to it, it's almost 50% constructed. And the liners will kick on there again. So what you see in the background, just for reference here, that's a 250 bed camp, and the power plant that is just sitting there. So this pond is 2.4 kilometers long, And we're building 4 of those that are at similar size. And importantly, from here until the first half of 2025, we'll be in production, we'll be in cash flow. And we are producing a premium product. We are producing 6% lithium content. And what does it mean? And Lowry call it liquid spodumene. If you are familiar with all the spodumene that is coming out of Australia, this will be SC13, not SC6. So it's 12.9 to be exact, but I rounded to 13. It's a fantastic high grade. So we got a product that we can transport anywhere that can give us a high premium of payability. Transport costs are less than half of spodumene. Operating costs, if you are familiar with the spodumene narrative, will be around $350 a ton for producing our concentrate. So not many spodumene producers can do that. And importantly, if the world remains the same way that it is today, at around $15,000 a ton, we'll be making more, we're making $6,500 a ton margin. So, you know, this is a business, and we are here to make money, look after the environment, look after the community, do our bit, but we're going to be sustaining the test of time. And well, now that I've given you a bit of a journey where we at and where we were, I'll tell you a bit more about Galan and why it makes it so different. We have today a resource update. We've gone from 7.3 million tons of lithium carbon equivalent to 8.3 million tons of lithium carbon equivalent. So that it's around 18% jump in our resource. Grade was maintained and actually was increased. We added a new tenement to the north, that's the Catalinas tenement. And importantly, to the north, grades go higher. So it's a gift that keeps on giving. And the more that we drill, the more we find, and the more that we see that the strength of our project is fantastic. And I don't want to distract you too much with things, but in a salt flat, grade and variability is really important. If you've got a cube, the distribution of the grade, as long as it's consistent, you know that you're going to get a consistent grade to put into the ponds and the evaporation. If that grade varies in that cube, then you need to start doing a lot of calculation and making sure what you extract from there gives you an average grade that goes into the plant, goes into evaporation, and you'll have the product that you want. I've seen 2 salt flats or 2 projects in Argentina and actually in the world today that don't have that problem. The one is the old Livent or Arcadium and us. Grade, it is consistent. And that's why we're so confident about the capability of Galan to produce what we said we'll do on time, on budget. And we are already a third of our project in, and that's been demonstrated by looking after our money, the cash that we're spending, what are we doing with Galan, and the advances that we're making is making good progress. And we've seen the evidence that is in our ponds. Now, the construction, as I mentioned, is going well, so more to in the presentation. The operating costs are very low, and that's what I was just mentioning in the introduction, $350 equivalent if we were producing spodumene, or $3,500 a ton in our phase 2, but around the $4,000 for being conservative, a price of $15,000 a ton, payability of a lithium chloride concentrate for being conservative again, use 70%, that leaves you with a payability of $10,500 a ton, the cost is $4,000 a ton, therefore $6,500 a ton margin. And that's something that not many companies can do. We've been gifted with a high-grade, low-impurity project, and allow you to leave this room knowing that Galan, when it comes online, will print money. Now, I mentioned phase 1. Phase 1 is the smallest one of the 4 phases of development, and then we'll have a table showing that next. In phase 2, we already done a DFS, so the engineering is done. Phase 2, we have already submitted the permit, and I just came back on last Saturday from Argentina. The discussions and the approach that the mines department of Catamarca is giving to all lithium projects is fantastic, and especially with us, because they're seeing what we're doing. We're following every step that we promised it will do, and they want to give us a permit for phase 2 within the shortest time frame possible within them. What does it mean? We believe that by mid-year, this year, or give or take, we should have construction permits for phase 2. Now, the exploration upside remains open. We haven't touched Candelas, and we haven't touched Candelas since 2019. There is an upside there. Grade is not as good as Ombra Muerta West, but the inventory remains untouched. So we'll go eventually there, and we'll have a remaining upside for Galan. Now, no project is a good project if you don't have a team to execute. And when you see this, you see a team that has experience of executing. If you've seen our releases on project update, you can see the advance that we do month by month, pond by pond. These guys, the executioners, are the same guys that built ponds for SQM for years and years. So this is a small footprint of what they've done. These are the guys that are expert in executing this. And the team that Galan has behind is pretty much SQM 2.0. So from the execution, from the operation, from the hydrogeology, from the commercial side of things, from people in the ground, we have the experience. And that is something that not many juniors in the lithium sector has. We do have it, and we are going to demonstrate in time that we can produce and be a cash flow positive company within the next 12 to 15 months. So with that, where are we located? That's a map of Ombra Muerta West. By the way, this presentation is online. You can download this at your own leisure. And you can see Arcadium in yellow, and that was livened to the left of your screen and then livened to the right. If everything goes well, I would like to think that we could come online before Sal de Vida. So that's our own goal, and that's what we're trying to achieve. Livent is doing their own expansion. They got the Phoenix plant down to memory lane. What I can tell you is that the lithium revolution started with the Sony handycams. So 30 years ago, Panasonic made lithium batteries that went into the Sony handycams, video cameras, by the way, and that came from our neighbors, from Phoenix, from Livent. So the history of the salt flat is not new in lithium. It's not new to the revolution that we're seeing with cars. This is good brine that can be converted into carbon. It's been proven for 3 decades now. Needless to say that we have a good, great project, and we have a large inventory that can give us 4 phases of development to 60,000 tons. We want to crawl before we walk, and then we can walk before we run. Importantly, there is a significant upside to Galan. So don't get stuck with what we are here in phase 1. Don't get stuck with the short-term things that we need to look at. Just look at Galan for what it can offer in the future, and it's not too far away. Now, the resource update, this is our 4th resource update. I already mentioned high grade. We have a significant portion of that into measured. What does it mean? It means that this can be converted into reserves. We have Ombra Muerta West directly 3 phases of development you'll see on the table, but we have more than enough to secure our reserve statement going forward. The reserve statement for phase 2 was for 40 years. So this is a multi-generational development. And we are there to make a difference in Catamarca with the community as well, and making sure that this works for everyone. Now, the construction update, as I mentioned, the percentages, that's all in there. You know, the big picture you're seeing, this is another picture from yesterday as well. You can see how much we're advancing, filling. There's already inventory on pond number 1. 2 weeks ago was around 500 tons and counting. The amount of lithium that we put in there, the evaporation that we're experiencing, the level of evaporation, and the way that these ponds have been put, actually some of the evaporation rates are better than expected. So hopefully this will continue, and it will help for us to start producing lithium chloride concentrate quicker. Now, we do have last year we signed an agreement with Glencore that's going through the motions. Everyone asking, where is it? All what I can say is that the timing that Glencore works is a different space timing to us. We want to get things done quicker, their speed is different. If there is a problem, as I mentioned in my previous presentations, we have to announce it. Things are slower than expected, yes, but at the same time, Glencore is a larger company and do things in their own way. We are not oblivious to the fact that things are taking time. I just want to give a peace of mind that we are thinking at different scenarios. That's all what I want to say. And Galan is not going to stop one way or another with what we're doing here in Glencore. We do have phase 2 coming up. We are talking about phase 2, not necessarily in Glencore. We have different parties that are very interested about this. So look, there is a solution for everything. Hard times, yes. Everyone is looking at when is this going to be done. The funding is probably underpinning the share price, and that's very clear. But I want you to keep a big picture about Galan, because the funding will get resolved, the execution will continue, we'll come in to be a producer in 2025, and we are going to be one of the few independent producers in Argentina. So a little snapshot about our share price, and all what I would like to highlight here is we tally held still. We did an SPP, oversubscribed. We thought that we'll get $1.5 million. We got $4 million. Why do we like the compelling numbers about Hombre Muerto West? This translates in the chart that you see behind you. You see that Hombre Muerto West will be one of the low-end cost producers. And the number that you see in there, all in sustaining costs, it is not optimized. We can move the cost into the left, mainly because the assumption on the study was to use diesel power generation. We move that into solar power, and we reduce our operating costs significantly. Importantly, we can say that we are one of the few companies that have got low operating costs, or will have low operating costs and low carbon emissions. And that's important from the ESG traceability, especially in the US and Europe. 4 phases of development that I mentioned, going from 5 to 20 to 40 to 60. There's a lot of upside coming up here, and this is why Galan can make a difference down the track. About the board, I've got fellow members of the board with me. I'd like to thank them for being so supportive. But this shows that we got a very strong team with Galan. And importantly, Daniel and Claudia, ex-SQM, and they add a lot of value into Galan, and they're based in Chile, importantly. The team in Argentina, Juan Carlos Barrera, ex-Senior VP of Operations, and that adds a significant value, and this is reflecting in the execution that we're doing. It's not working. Well, and lastly, Green Bushes, come to see me. We have a booth, and thanks very much for your attention. Thanks. Sorry, Chris.
Thanks so much, JP. I knew you'd go straight to time. I walked up here with the 15 seconds, and you didn't disappoint until the clicker died. Thank you so much. It's a really interesting story. We're going from South America now. We're moving over to Europe. And the largest hard rock lithium resource in Europe. It's located in the Czech Republic, and it is the focus of European Metals Holdings, our next company to take to the stage here at FFC. Sinavec will be, according to this fellow here, and his troop, a fully integrated lithium project producing battery-grade lithium hydroxide and/or lithium carbonate for the rapidly growing European battery industry and electric vehicle industry. So who is this fellow? If you haven't had the good fortune of meeting him yet, I advise you to go out and have a chat with him afterwards. He's a wealth of knowledge. This is Executive Chairman Keith Coughlan, and he is going to provide us with an overview of the European Metals Lithium story. Welcome to you, Keith.
Thank you very much, Chrissy. And good morning to you all. Thank you to the organisers for putting this on. It's a fantastic conference. So as Chrissy mentioned, we're developing the Sinavec project, the largest hard rock lithium resource in Europe. It's in the Czech Republic, a historic underground tin mine that actually was mined for tin for somewhere near 600 years, ending in the late 70s. So a long history of mining in the region, obviously the usual disclaimer. But as we mentioned, it is a fully integrated project. So our end product is not a concentrate. We're going all the way through to battery-grade chemical. We have produced both lithium hydroxide and lithium carbonate in our test work at battery-grade standards, and that'll be sold directly into the EU EV market, which is obviously growing very quickly. A couple of headlines of the project here on this slide, as you can see. We've got some very significant partners with us in the project. Our project level partner is a company called ČEZ. It's the Czech national power utility. They own all of the grid or the power grid, but in Czech Republic, all of the EV charging stations, but they also have significant green energy assets as well, solar power, wind power, etc. Very handy partner for us in country. We've got a formal relationship with the European Union via the European Institute of Innovation and Technology, EIT. The EBRD, the European Bank for Reconstruction and Development, is a shareholder of European Metals, and I'll talk about that a little more in a couple of slides' time. And DRA Global are finishing our definitive feasibility study at the moment, which we hope to get out to the market very soon. The project does have very good ESG credentials. We are re-entering a historic underground mine, which clearly is a lot easier than starting from scratch and trying to break new ground. ESG credentials very important everywhere in the world, but in particular in Europe, in the EU. I mentioned the EBRD. So the EBRD was established post-war to help Central and Eastern Europe to rebuild. They've had a very strong commitment in the Czech Republic, as you can see there, have committed over 1.4 billion euros to reconstruction in the area. They are a relatively small shareholder of European Metals, but they stand with us to help develop the project going forward. They are also very well connected with the European Investment Bank, the EIB, and there's plenty of public statements from both of those organisations about their willingness to help fund the energy transition in Europe. The EU itself, fully committed to sustainability, fully committed to building a battery industry and fully committed to an EV future. There's been a lot of money pledged from the EU in various ways to help develop the new industry. But to be fair, it's been a little slow getting from those statements through to projects on the ground for a couple of reasons I'm going to discuss. We see an acceleration in that beginning now. The Critical Raw Materials Act mentioned here was passed. It was adopted on the 18th of March, so a month ago. What was that, a week ago, 2 weeks ago? And it'll come into effect in 20 days' time. So the key tenets of the CRMA, from our point of view, is effectively it will help speed up the permitting process in Europe, which is slow, and make more funding available to projects like ours. Europe understands that it needs to help enable these projects if it is going to have any sort of self-sufficiency in battery metals going forward, which is what they've stated they want to do. The CRMA will release shortly a list of strategic projects. We've clearly made application to be included in that list. Synovix has already been granted strategic project status under another EU scheme, the Just Transition Fund, which I mentioned here. We've been pre-approved for a grant of approximately 50 million euros via the Just Transition Fund, and we believe that that money will become available from May this year onwards. Some more, I won't dwell on this one from a time point of view, but commitments from the EU which have recently started to become more concrete, and mainly because of the EV situation in Europe. So we still see good growth with the take-up of EUs right across Europe, but a slight slowing down in Germany, removed subsidies for EVs late last year. But the interesting part is what we're seeing from the Chinese, and obviously, you've heard this if you've been to any of the previous discussions over the last couple of days. Chinese EV penetration is nothing short of astonishing, as you'll see from the numbers there on this screen. What's important from the EU point of view is now the number of Chinese-built EVs going into Europe, threatening market share in Europe. The European car industry is a 650 billion euro a year industry, employing about 13 million people. And clearly, that's a lot of jobs, that's a lot of votes, and the EU is aware of the fact that it needs to keep up with the Chinese domination in this area. It's not even so much about Chinese domination of the lithium market, but Chinese domination of the world car market. So this is, in my belief, why the EU has woken up. You know, they have been coming last in a global sense in regards to putting in place the sort of legislation that they need to. The CRMA really is Europe's answer to the IRA. I don't think we'll see the same sort of numbers, but we'll definitely see the same sort of theme emerging. So obviously Chinese domination of the battery market, everyone knows about that. Interestingly here, we're seeing just in the last week, you see the British flag there, just in the last week, the announcement for Eve Energy of a commitment of 1.2 billion excuse me, pounds to a battery factory in the UK. From the point of view of the German and the French side of things, we've seen the ACC, the joint venture between Mercedes, Stellantis and Total, through SAFT, commit 4.4 billion euros to 3 gigafactories across the region. So we're seeing that side of it kick along, and obviously these factories need lithium, and they'd like to source a reasonable chunk of it from Europe, if at all possible. The project there, the gold star in the middle of this slide, you can see completely surrounded by these potential off-takers, the groups I've just mentioned, but obviously all European OEMs. The solution to building these projects in Europe is a collaborative one. So it will involve all the parties necessary to enable the projects, the EU themselves, the Czech government from our point of view, who are very positive, very supportive of our project, but it also includes those OEMs, EIB, EBRD, etc., coming together collaboratively to build the projects. You know, a lot of my shareholders say to me, why haven't you signed offtake agreement? Well, I'd like to borrow from Ron Mitchell there, offtake is your weapon. You don't give it away lightly, and it's part of this whole enabling process. So when we do go to offtake, it'll be as part of the whole solution to building out the project. The project itself, so you'll see the blue dot at the top of this slide, right on the German border there, on the Erzberg ranges that form a part of that border. Historic underground tin mine, as I mentioned. Slightly smaller blue dot, bottom right of that one is the proposed portal entry site. And then further south, you see the proposed processing plant site. I'll show this slide to demonstrate the mining history of this region, which is very important from the point of view of community acceptance, social license to operate, etc. You know, those are historic coal pits in the region, many of which obviously remain unrehabilitated at this point in time. Part of our plan is to use a significant portion of our tailings to help rehabilitate some of these historic coal pits, most of which are owned by our project level partner, Ches, and all of these go towards assisting us with our ESG credentials in the region. Cinovich is a very large lithium resource. I mentioned at the top, largest hard rock resource in Europe. I showed this slide just to demonstrate what percentage that Cinovich actually represents. And this is important from the point of view of long-term security of supply, but it's also very important from the point of view of attracting the attention of the EU, of the EIB, etc., because of the proportion of the potential supply that Cinovich can deliver into what's a very rapidly growing demand scenario in the region. We produced through a fairly simple or relatively simple process, very high-grade lithium carbonate. I hope to be able to put up a slide on lithium hydroxide that looks like this next week when we've completed that test work, and believe we can. Maintaining the ability to produce both of those two battery chemicals is important for us. Both are required in Europe. The carbonate scenario is becoming increasingly important, but both chemicals are very much in demand in the region, and keeping the optionality on what we end up producing as the end product is important to us. For those interested, this is the flow sheet, or a simplification of the flow sheet, demonstrating the ability to produce both of those chemicals I just mentioned. Interestingly, we can also produce two high-grade precursor chemicals, lithium sulfate, lithium phosphate, both of which are becoming increasingly important. There's no clear market for either of those just yet, but again, goes to our optionality on what we end up producing and who we end up selling that to. Historic mining areas, I said, so all the infrastructure is in place. it's a first world location, and as I mentioned earlier, in a historic mining area, so we don't have to overcome that local acceptance of mining. ESG credentials are very strong. We had an LCA produced when we completed the PFS. That's almost 2 years old now, so that will be updated with the DFS over the course of the next few months. But as I say, this is very important. When you go to talk to potential off-takers in Europe, it's almost the first thing they want to know is your sustainability, your green credentials, and it's not just talk. The consumers, our customers, are very focused on this. The LCA I mentioned just on CO2 footprint. You see the two bars there of Synovitz. The second is with the use of green energy for the project. CEZ, as I mentioned, is the power utility in the Czech Republic. They have committed to delivering green energy to the project, so it gives us a very low GWP. The project is also rated very favourably with regards to water usage and acidification. So again, very high ESG credentials. The board management team that we've put together, we've managed to recruit a couple of key industry people out of other projects around the world, and it's very, very handy doing that because obviously, there isn't an enormous amount of lithium experience in the world. It's still a relatively new industry, but this is the EMH team, and that's strongly augmented by our project level partner CEZ, who employ something like 35,000 people in the Czech Republic, many of whom we get to tap into at very low cost to us. So going forward, the bottom half of this slide, I think it's the important part to focus on. So those strategic partner discussions are well underway. As I say, it will be a collaborative approach involving all the necessary people to enable a project like this, which will lead into the final permitting. It is slow, but that'll speed up with the advent of the CRMA, slow by global standards. The completion of the DFS, the pilot program. So we've completed the pilot program for lithium carbonate. We have those samples ready to pass on to potential offtake partners, and the hydroxide part of it will be completed very shortly. And at the bottom there, very importantly, Synovex being such a large resource, our phase 1 production is a shade under 30,000 tonnes per annum of battery-grade hydroxide or the carbonate equivalent. That's a relatively small production profile for such a large resource. So we will be embarking on a study to look at significantly increasing that production as we get towards the end of the DFS. I've timed it almost perfectly, Chrissy. Thank you all very much for your attention. As Chris said, got a booth out there just behind the EV. Please come and have a chat to me if you'd like to know anything more about the project. Thank you very much.
Thank you very much, Keith. Great presentation, considering the time to which you were out last night. Yes.
No story.
I believe there was a gang of lithium presenters out last night, and they may have tried to lead our next presenter astray as well, but he stayed firm because he knew he had big things to share with you today. So he's the only one, I think, with a real spring in his step today. So I actually asked him to describe himself to me so that I could describe him to all of you today. And he said, oh, Chrissy, I'm going to be one that's not going to overstay my welcome on the stage. So we really want to eke out our residual value from you, though. So will you notice that I've managed to find you an extra 5 minutes today?
Okay.
So at least look happy about that, please. Ladies and gentlemen, would you please put your hands together for the great Joe Lowry. Let's talk lithium.
Given the massive largesse I have just received from who I called yesterday the Angel of Death, when she came to kick us off the stage after the panel, I'm going to start off with a bit of trivia, and I don't want to throw my friend JP under the bus, but I kind of will, because he did talk about the Sony battery in the 90s. That did not come from Hombre Muerto. Later it did. The original raw material, because I sold it to Sony back in the day, that's how long I've been around, came from a hard rock mine in North Carolina. And when that mine shut down, we transitioned to Hombre Muerto. So he didn't tell you anything that was not true. I just wanted to give you that little additional bit of clarification. The original material that went into the lithium-ion battery was hard rock mined in North Carolina, processed in North Carolina. And the reason I go through this is I kind of want to take you guys full circle because America's trying to be a lithium producer again. But we were the original guys. So with that, I will get on with it. Last year I stood up here in kind of a very different scenario. I called it the lithium decade, and I still believe it is the lithium decade. Absolutely believe that. But in any industry that's going to grow 10x in 10 years, and that's about what the numbers will bear out. In 2020, lithium was about 300,000 tons, and in 2030, by most accounts, it'll be at least 3 million. Anytime you have an industry that grows that fast, you have growing pains, and you have volatility. And that's kind of where we are. I loved what the first presenter from Argonaut said about price. I completely agree with him, and we'll get into that. But I'm not here to tell you how to think, but I am here to give you some questions you should be considering. And that is where I will start if I can get this thing to work. So, we've been through a ride in lithium price. It's been pretty dramatic. We've heard it referenced before yesterday and today with the first speaker. Lithium prices went up to 80,000. But why did we have that price bubble, and why do we have the drop in price today? And I would say to you that if we look at the panic buying that went on in 2022, and you have excess capacity all over the lithium-ion battery supply chain in China, and that is going to continue to be a problem. It's going to continue to set up volatility. And if you spend any time in China, and I know a lot of people in this room have, and I lived there for a while, what happens? They just keep building capacity. And when you do that, and they started to drive the lithium price up, I never thought the lithium price would get to 40,000. That's how smart I am. And I sure never thought it would get to 80. When it got to 80 and kind of peaked out Q4 of 2022, the lithium-ion battery supply chain was stuffed from cathode to cells to packs. And what happens in China when they see the price start to ease and come down? They stop buying, and they start living off the inventory because they think next week it's going to be cheaper, so why should I buy this week? And then we saw the rundown in price, and the narrative became, well, high prices, fixed high prices, those high prices attracted lepidolite and low-grade ore. Was it Andy Leyland on my podcast? Andy's the only one that agrees with me that it was really more for sure, but I think it's going to happen this year if it hasn't already happened. And I think Ron talked about it yesterday, and it's been alluded to today. Albemarle followed on Pilbara's BMX auction with their auction, and the prices, okay. Wasn't great, but it was okay. And it does seem like prices have bottomed. But that's a question that you need to ask yourself, especially if you're going to put money in the market. And Keith's already talked about it, the Argonaut guy talked about it, I'll talk about it a little bit, but is the EV growth story still intact? You need to ask yourself that question, because the narrative, and coming from the United States in an election year, EVs have become a left versus right kind of thing, and it's very political right now in the United States, and there's a lot of stories about, no, people don't want EVs, they're gonna buy hybrids if they buy anything. The EV growth story is still intact. I'll show you the numbers. Keith showed some numbers. I don't want to beat it to death, but EVs are going to do just fine. But you have to be comfortable with that, because the lithium industry is now completely tied to batteries. And I'll show you a pie chart in a minute. But when I started, there was not a commercial lithium-ion battery. And now it's really all that matters when you're looking at lithium demand. And then what's the cost curve look like going forward? It's going up. We'll get into that a little bit. And finally, we had the DLE guy on the panel yesterday. And that's a question that continues to be out there, is when will DLE make an impact? I think it will. I don't know when. But you need to be looking at that, because that really has the capacity now that you're getting companies like Exxon involved with huge balance sheets that can do whatever they want to do, that aren't troubled about raising the money to do DLE. If that goes, if I'm a small hard rock guy, I'm going to start getting very nervous. What are my assumptions? Well, Henry Sanderson showed a nice slide yesterday about China's dominance of the lithium-ion battery supply chain. I completely agree with what he's saying. China is dominant, but there are too many suppliers in China right now. We have too much capacity, and that's going to continue to drive volatility. And you're going to have, in the first gentleman who spoke talked about, it's going to be tough to supply this market, even if you have limited periods where it looks like oversupply. And I think he's right. But the battery destocking and restocking is also going to add to volatility, and you need to be watching that. And I think BYD and CATL together, and I'm not a conspiracy theorist, but I will say that I think they've done a great job of taking control of the lithium narrative as well. And I think that's the kind of thing. I think you need to be really skeptical about just about everything you hear coming out of China about what's happening. I think many of the analysts have been co-opted and tend to sing out of the battery maker's songbook when they talk about the industry. And I think it's a real concern. Capital intensity keeps going up. That's going to drive the cost curve. There's some Canaccord numbers that say that the average capital intensity has gone up 50% since 2019. I think that's close, but if you look at, and I'll talk a couple times about Thacker Pass today, which just got the big loan, and I think Scott talked about it yesterday. A couple other people referenced the $2.26 billion DOE loan that they're getting for Thacker Pass. Well, if you do the math on spending, the whole project's $3 billion, the DOE can't loan for the mining part of that. That's a pretty high capital intensity number. It's pushing 60,000 a ton. So that's going to continue to drive the cost curve up. And you're going to see that happening, and you're going to probably see it on just about every ex-China project that goes on. The capital intensity keeps going up, which is going to drive the cost curve up. And lepidolite, I think my friends from Arcane, they have a nice slide about lepidolite. I want to give them credit for that. I didn't use it in my presentation, but the lower grade lepidolites are probably at $25,000 a ton or more. So you can't have a consistent growth. You can't have 400,000 tons of lepidolite in the market if the lithium price stays at $15,000 a ton. It doesn't work. We're going to need an incentive price. And then the narrative on lithium has gotten so negative. I've been in the business, as I think I said before, 34 years. I've never seen sentiment this negative. And it doesn't make sense to me. Because even at $15,000 a ton, historically, that's a pretty high lithium price. But the narrative now is all, well, it was 80,000. And that is one of the key takeaways I want you to have here, whether you agree with me or not. I want you to think about it, is there isn't a lithium price. The China spot price is not the lithium price. There are a range of lithium prices. Korea is the second biggest market for lithium chemicals in the world. Japan's third now. But in both of those countries, last year, the average price for, in Korea, lithium carbonate and lithium hydroxide averaged about $50 a kilo. Carbonate in Japan last year averaged $56 a kilo. And you can say, well, I don't like you to talk about averages. You know, where did you end the year? You ended the year in Japan at $40 a kilo. November was 35. October was 35. So the price fell 80%. On the China spot price, that's true. But when you start looking at the lithium industry, think a little bit deeper than what Reuters tells you the lithium price is, or Bloomberg NEF tells you the lithium price is. It's a range out there. And when you talk about lithium price bottoming, there's going to be multiple bottoms because there's multiple prices. And you should think about that too. So, what are my expectations? And I'm going to repeat myself. I'm going to say EV probably 20 times in this presentation. But I believe price bottoms this year. I'm not smart enough to know when that is, and I believe it will start to rise. I already told you about the Japanese prices and how different they are than the China spot. One thing we have seen this time around that we haven't seen in the past is that the major lithium suppliers have, whether their discipline holds or not, I don't know, but they have either taken capacity off or delayed projects to try to make sure the market goes the way they want to. And we've had Albemarle, SQM, Arcadium have all made moves to try to make sure that things stay in balance. And I think that's a good thing. We've never had discipline in the lithium industry. It was always about sell as much volume as you can. So to have SQM behaving in a disciplined manner is a fresh thought. EV growth is going to continue. That's my core assumption. And if that doesn't happen, then I won't be here next year for sure. RowMotion, there's a lot of different numbers, EV numbers. I use RowMotion. I think Anthony C. used somebody else's numbers yesterday. His number for last year was it was over 14. Mine's 13.8. It doesn't really matter. It was low 30% growth last year. RowMotion says 2024 will be 18. I'll have some forensics on that number in a minute. But then the other thing the great thing about the fall in price was you're not hearing a lot about sodium ion right now in energy storage systems, because if lithium stays below 25,000 a ton, sodium ion is pretty much a dog that doesn't hunt, and it will have a very small niche. At 80,000 a ton, ESS wasn't going to grow. ESS is booming right now with lithium technology, and RowMotion's projection for this year is roughly 200 gigawatt hours. You put a lithium intensity number of 0.8 on that, and basically it takes you 4 world-class projects, 4 Kacharis, which is in startup right now, to just do the demand for energy storage. So EVs are important, but energy storage is going to be increasingly important going forward. Geopolitics. I come from a country with more than 340 million people, and we're down to Biden and Trump again. Sorry. Now, I'm not gonna get into that because there's a breakfast tomorrow where I believe a gentleman's gonna talk about the US election. But a lot of things aren't gonna get settled with where EVs go in the United States until we have that election over and we can stop saying, well, Trump will kill the IRA. Trump's not gonna kill the IRA. It's not in his best interest because most of the investments that'll go into batteries in the US are in Trump states. Trump's going to start more oil drilling, and the environmentalists aren't going to like that. But to paint the EV lens, I heard Donald Trump say last week on CNBC that I'm not going to let BYD build in Mexico and bring those into the country. I'm fine having BYD build a plant here because I want the jobs. That shocked people. And I promise you, Joe Biden's not going to ask BYD to build a plant in the United States, because that's not how that works. I'm not going to get into other countries' elections because I know precious little about them, but there's a lot of geopolitics that are getting settled that are going to impact what happens in the energy transition. I just unhappily am from the country that has Biden running against Trump yet again. Okay, what's the market look like? They're different people have different numbers for what happened last year. I have demanded about 925. Some people have a million tons of LCE. They're all pretty close. The important part about this pie chart, and I said something similar last year, if any of you were here last year, this used to be a beautiful, colorful chart. It is increasingly blue, and blue represents battery. Lithium has just become a battery-dependent business. And by 2030, more than 95% of that little pie chart will be blue. And that, all you have to know to project where the lithium industry is going now is where our battery's going and how many gigawatt hours or terawatt hours are going to be made. I'll repeat myself, this is industry's all about batteries. This is a supply chain insights slide. It basically shows you the different components of battery, EVs, ESS, and then portables. EVs dominate, but ESS is increasingly important. If we want to parse that down to each category, you can see the numbers yourself. This year will be 1.2 terawatt hours, which if you put a lithium intensity on it, it yields about 1.1 million tons of lithium demand for battery. And that is significant growth, and I don't think you need to worry about where the industry's going from a demand standpoint. Most of the arguments that any of us have are about supply, not about demand. The EV, 18 million units, over 10 of them are China. That's the level of dominance, and I don't think that ends anytime soon. And I don't think it's a bad thing. I think it just is what it is. Europe, 3.8, the US, or it's actually North America, US and Canada, a little over 2. Maybe that doesn't grow as fast as people expected, but that's one of the things Americans hate. We're just not that important right now in the global EV story. There's still a lot of range anxiety. Our players in the EV market have failed miserably. You don't see a lot of GM EVs or Ford EVs on the road. And that really kind of controls the narrative in the United States. And I, for one, would love to see BYD's cars sell in the US because they have, if you really want ubiquitous EV adoption in America, if you let BYD in, then guys that can't afford Teslas could afford an EV because they have EVs at every price point. And we just don't have that. Elon likes to say, in the negativity of the narrative, a lot of it is anytime Elon talks, that's what the story is. And Elon says he's in between two growth waves because, you know, whatever they call their $25,000 model, whether it's the Model 2 or something else, until they have it, we really don't have, there's just not a nice car you can buy until they let the Chinese cars in that are at a price point where we're going to get huge adoption growth in America. And I don't want to make this America-centric, but it is the second largest car market in the world after China. There has been a lot of negative press about, you know, people will talk about every perturbation in the growth of EVs in China. This is current as of the end of February. Yeah, it's a sawtooth chart, but directionally, it's going in the right direction. So I think people can just stop worrying about NEV demand and its new energy vehicle in China, and that includes plug-in hybrids as well. But despite the seasonality, and the China market is very seasonal, and people will read that, oh, the last 2 months sales were down, so the sky must be falling, but that's not the way China works, and that's a good indicator, the way that's a sawtooth, but the direction is up. Supply forecasts. That's where I say most of the disagreement in the industry about where we're going between now and 2030. It's not about demand, it's about supply, and if it's oversupply, then it's a different price story than if it's a tight market. I'll refer to a podcast episode again. I talked to Andy Galan and I said, why are the supply forecasts so bad? And he says, well, if you work at a big iBank, the job you don't want is going through all the PFS and DFS to create a supply forecast. So the new guy gets the worst job. And generally speaking, he does a bad job at the new job. And if you look at, and I usually will pick on Goldman or Morgan, but I'm not gonna do that today. You can take anybody and look at their forecast between now and 2030, and you will see projects on there and volumes in there where the project's not financed, and right now financing is going to get tougher and tougher until people have clarity on price, especially ex-China. And the Chinese analysts always put any Chinese project as being on time and ramping quickly. And trust me, it doesn't matter who it is. Lithium projects are always late, except for maybe JP's. I don't want to throw them under the bus again. And they ramp rather slowly. And if you're from WA, you talk about lithium chemicals, you've got Kwinana and Kemerton as evidence of that. I was talking to somebody this morning, I said, go out on YouTube and look at the original Kwinana video from, I think they were supposed to be ramped in 2019, and they haven't taken that video down, and I don't understand why that is, but they haven't done it. Increasing capital costs and lower price expectations, as I'll just repeat myself, it's going to affect financing. It already has. Everybody in America is just thrilled that Thacker Pass got that loan. Let me put that in perspective to you. Last year I showed you a map of gigafactories. Keith showed one for Europe. There's a map of North America. There's 25 or 30 gigafactories out there. Thacker Pass will take 3 years to build, another year to ramp, and it does one. A 50 gigawatt hour gigafactory will use 100% of phase one of Thacker Pass. So if America's gonna build a robust, or North America's gonna have a robust battery supply chain, there's gonna have to be a lot more investment than we are seeing now. Because you can't find another financed lithium project in the US right now. And even Albemarle reopening Kings Mountain, a brownfield, they've backed off on the timing of that. So how does this happen? And if you can't build lithium projects, you can't have a China-free supply chain. That's pretty simple logic. Chile. Chile has a lot of potential beyond the Atacama, a lot of salars, very much similar. There's a lot of potential in Argentina, but there's a lot of active projects in Argentina. But when Chile elected a communist leader and they changed their lithium policy, if you're going to develop, the Atacama was left alone except for SQM was basically forced because of the expiration of their agreement to do the deal with Codelco. And there's a couple other projects that are grandfathered, but anything else that's going to get developed in Chile is going to have somebody that's willing to give the government a 50% plus 1 share majority ownership and a carried interest. And from my perspective, there's only one country that will be willing to do that, and it's China. Chinese money will flow in. And I don't know if Boric will not get reelected and that those laws will change, but there's a lot of potential and everybody loved the Chile story because they have a free trade agreement with the US, so they'll be IRA compliant. But if no Western company is going to be willing to put the capital in the ground, it's going to be a problem. So the other thing that's required for new projects in Chile is DLE. And right now, there is no commercial DLE, pure DLE out there. And until there is, you're taking one of your best lithium provinces and kind of putting it on ice. Whether it's Henry or any of the other people that have talked about China's processing lead, that story tends to be skewed to hard rock because WA hard rock goes to China, almost all of it, until the project, the Queenan and Kemerton are actually at scale. But what doesn't get told in the narrative is that the brine projects pretty much make the lithium chemicals at the brine project or nearby. So when you bring brine into the argument, China's processing lead is much lower than what people think. It's still major, it's 64%, but it isn't the 90 to 95% that people talk about when they only consider hard rock. So China's processing lead is going to continue to decline as brine grows. And I think that's an important point when you're trying to get a balanced view of what's happening in the lithium industry. The Western Hemisphere was very slow to put capital in the ground and still isn't at the speed it needs to be. But I like to try to paint a balanced picture that Chile is, nobody ever talks about Chile as being a processor because it's not the way they think about it. But if you're making battery quality at the site, then you're not dependent on China. This is my supply and demand number. People think I'm a wild lithium bull. I think it's pretty much a balanced market until the end of the decade, where I think it's going to be hard to get to 3 million tons of supply. But the other point that's important here is that when you start operating at 90% capacity, you're going to have shortages. And what the analysts usually say is it's supply, demand, and if it's one LCE over, it's oversupply. That's not really the way it works. And because the supply chain's so low, Anthony C. yesterday during the panel talked about the lithium in his Tesla in Hong Kong. And back in the day when he got that first Model S, I think it was mined somewhere, or it came out of Hombre Muerto. It went to Bessemer City, North Carolina. It went to Shikoku Island, Japan. It went from Shikoku Island, Japan back to a Panasonic factory. It became a cell. It went to Fremont. It became a Tesla. And then it got shipped to Hong Kong. Lithium's got to travel a long way. The supply chain is really long, and not much is happening to change that. So you're going to have tight markets even when supply looks on a spreadsheet like it's in balance. These are Goldman's numbers. The only reason I point this out is because Goldman Sachs has very low pricing in, like they say 2025, they've lowered the price to $10. And that's essentially on the back of what they think is going to happen in lepidolite. But their supply and demand, their demand numbers higher than mine, and their supply numbers a little higher than mine. But even Goldman has 2030 in a deficit. So most of the people looking at this industry going forward are not that far off. The only thing I really have a disagreement with, and that's why I rely on my buddies from Arcane on their lepidolite costs, but you can't have $10 lithium if your growth is in China's lepidolite that costs $25 a kilo to produce. And yes, there's some lepidolite that's lower than that, but it's a spectrum of cost, and that's something you need to keep in your mind. Canaccord, I'm much more on Team Canaccord. They have their undersupply is actually bigger than mine, And there's going to be market tightness, and that's going to put price back up. The real question is, how high will price go? And I believe what the last cycle, the last 18 months has showed us is that there is swing supply. The lepidolite and the grinding up ceramic material and bringing in DSO from Africa, if you have another run up above 40,000, all that's going to come back into the market, and it's going to come back in quickly. So I think we have found that there's a natural cap on a price run up. I'm not saying price will never go to 80,000 again, but if it goes there, it's not going to be there for very long. And that's spot price, because, well, let me show you an SQM slide in a minute, and I'll explain what I mean. This is Albemarle's numbers. Albemarle's actually downgraded their 2030 forecast. Last year when I was here, it was 3.3, it went up to 3.7, now it's back down to 3.3, but in all cases, it's 10% higher than my best number, and it's about the same as Goldman's. The cost curve. Price is going to be determined by the cost curve, and this is Canaccord's 2024 cost curve. All we've had happen in the last few years is the cost curves got steeper. And it's not just Canaccord. Morningstar, Seth Goldstein's their lead analyst. This is their 2030 cost curve. He only has 2.5 million tons of demand because he says that he thinks it's supply limited, so it's not real demand. You can debate that number, but you go up to 20,000 in his numbers for lepidolite, which would keep price where into the 20s. A lot of these projects get wiped out because this is just the DFS cost numbers. And if you're at 15,000, a lot of that doesn't get built. It sure is not going to get financed. And the other thing I would say is price at C1, and I don't want to get into a lot of jargon here, but C1 cash cost is basically real cash cost. C2 is you add depreciation, amortization. C3 is you add corporate costs. And you have to have, it's C3 costs that really drive what people will invest, not the cash cost. Because when a market's growing as fast as lithium is, you got to put capital in the ground, and you don't put capital in the ground when your expectation is to get your marginal cost back. Lepidolite, this is another number from Andy Leyland's Supply Chain Insights. Just shows in his mind, lepidolite is going to be much more limited than Goldman thinks in terms of volume, but it's also C1 cost at 14.1. You don't build a lot of projects with lepidolite. Price. I've got 5 minutes left, and then she's going to stand up, and she's going to do this, and she's going to do this, and she's going to start walking towards me. So I am prepared. Simple benchmark slide. Everybody knows this story. 80,000 to 13, I think, at the low point. But this is what I look at. The most transparent reporter of lithium prices is SQM's quarterlies. And this is the story I want to leave you with on price, is that in Q4 of 2020, SQM's LCE yield, and you can go online and look up the numbers yourself if you want, because they're all out there, all their quarterlies, was 530. It rose in 2 years later, in Q4 of 2022, it went to 59. It didn't go to 80. In Q4 23, it was down to 16. I don't know what their Q1 number is going to be. I have a suspicion that it's going to be at least 16 because I've looked at the Japan or the China import statistics from Chile for January and February, and they're still around 16, and that's their low price. So what they're selling to Korea and Japan's at higher price. So that may turn up. So maybe we have bottom, but I'm not calling it yet. But my point is, if this is the low on the right-hand side at 16, it's 3 times higher than the last low. The cost curve's higher. You're not going to have a 530 quarterly report from SQM again in my lifetime. Morningstar. I guess I like Seth because we agree. he shows 2024 pricing by Q4 going into the low 20s. This is an old Albemarle slide, and there's a caveat on it. This was done when their forecast was still 3.7, but they made the case last year that pricing had to go to 20 in order for enough projects to get built. And even with $20, they only showed 2.9 million tons in 2030. So they said there would be a 800,000 ton shortfall. Now that shortfall by their new demand estimates, 400,000, but you get the picture. That's more than demand was in 2020. So, I mean, all things kind of lead to higher prices. How high they go, I can't tell you. My thought is this year, price gets into the low 20s, probably in Q4. I don't know. That's my guess. But what do other people think? Canaccord, the last report I have from Canaccord, which is pretty recent, $16 in 2024, long-term 22. Goldman, 11. I mean, I don't think it's possible for them to be right this year because price isn't going anywhere near 11. And to average it down, price would have to go to like 8. And I don't think that's going to happen. Next year, they said price is even lower. And then their long-term is reasonable at 18. Macquarie, they're all over the block. I mean, the next one, their numbers change more dramatically than anybody's in my mind. But this is where their last report was, and that's quite recent. UBS. But there's pretty much consensus that lithium prices have to be higher than they are today to meet the supply expectations. I'm going to finish early. 1:58. Okay, closing comments. What do I want you to take away? Because I really, everybody needs to work this out for themselves, what they think, how they think about this, assuming you care. Banks are going to continue to try to force feed the commodity narrative. I said it last year here, I'll say it this year here. I know it's future-facing commodities conference, but lithium's not a commodity. It's a specialty chemical. The only people that can make it a commodity is the battery guys, and they'd have to agree on specs. You can't warehouse lithium hydroxide and take delivery because specifications and approval, especially for electric vehicles, are an arduous process. And you just can't have a random warehouse full of lithium hydroxide that meets a certain spec because it has to be individually qualified. Excess capacity is going to keep driving volatility. This is not going to be a smooth road. I think you could see $40,000 or $50,000 lithium again between now and 2030. I hope that doesn't happen. I'd rather see a stable environment. But when the Chinese go back to buying and restocking, it could get ugly. And I do think once you get to 50, then the swing supply will come in pretty quickly. I don't think it needs to go to 80 for that to happen. But it did not happen in 2017 and 2018 when the price got to the high 20s or around 30. That was the high point of the last cycle. And you didn't hear people talking about lepidolite then. So it had to go higher for that to even be brought in. There is no shortage of lithium. All the lithium that's needed for the energy transition has already been found. Hasn't necessarily already been drilled out, but people will say, well, there's not going to be enough lithium for the world. Don't worry about it. There's plenty of lithium, and later on there'll be recycling. Are you going to give me like 2 minutes from the time that we started early? Okay, thank you. She's so nice. There isn't a single lithium price. I've said it. I like to repeat that because people don't seem to learn that quickly. The China spot price is not the lithium price, it's a lithium price. And if you're going to invest in lithium, I will hearken again to the words of Anthony C. He didn't say it here yesterday, but I've heard him say it many times. If you're going to invest in lithium, do the work. It's not that hard if you really want to dig into what's going on. You can do it. You don't need me. You can do it yourself, DIY. And then you can also listen to the Global Lithium podcast and hear a lot of people that know a lot about this. I've got several people in this audience that have been guests. And with that, Chrissy, I leave it to you.
Are you
Thanks.
sure? Team, thank you very much. I was actually going to take my last 32 seconds and shake your hand. Yeah, I would think so. That's right. I didn't even wear a watch today. I just wore diamonds, just so I didn't have to keep my eye on the time.
Let's do
hugs.
hugs.
Absolutely bloody brilliant. Thank you so much.
Thank you.
I really appreciate it. Put your hands together again, team. And he will be here today. We just need to keep you away from those lithium people who lead you astray. That is really good. And if you'd like to recommend that talk to people, I actually started taking pictures of the slides, and I realised that that's one thing that Joe doesn't really like us to do, because that is his personal intel that he's sharing with us here exclusively. So, but you can, of course, tell people to have a look at our YouTube channel, and they'll be able to keep up with what it is that he was saying and imparting to us. So we've heard a lot about the fact that lithium is paving the way to a decarbonised future. I think the question that we all ask is, as we are claiming this lithium, how do we work to address how we decarbonise the production of lithium? So our next company is a leader in this field, a thought leader in this field, Vulcan. And Vulcan's purpose is to empower a net zero carbon future to supply lithium chemicals and renewable energy from Europe, for Europe, via its zero carbon lithium project. The company's founder is Dr. Francis Wedin, a battery materials and renewable energy industry executive, and he's going to discuss the recent progress. Oh wait, I've been told to go backwards, excuse me 1 second. Oh, you're quite right, Gernot. Excuse me, and you did get to stand up and I ignored you completely. So our next talk, excuse me, is with Dr. Francis Wedin and Vulcan. So we're talking Lithium Universe. How I could miss Lithium Universe, because it's so big, it sort of does block out a lot of things. So this is the dream team we're talking about now, led by lithium pioneer Iggy Tan and the dream team, LU7. They've got a really bold vision of building a lithium resource and refinery facility in Canada that will provide the critical materials for batteries, helping the world to transition toward a cleaner and greener future. So this is the company's executive director, Gernot Abel, and he's going to provide some further insights into this. And Gernot, my apologies for skipping over yourselves. Okay. Could you please make him very welcome, everyone?
After a 10-year hiatus, a new lithium company emerges from the galaxy. Introducing Lithium Universe Limited, committed to building a lithium future. Our company is chaired by the original lithium trailblazer, Mr. Iggy Tan. Iggy ran Greenbushes Lithium in 1995 and was the first to commission a lithium carbonate plant in Australia. Iggy was also one of the first mining executives with an eye on the lithium-ion battery future, some 25 years ago. Iggy and his team built Mount Coughlan, rated at 137,000 tonnes per annum, and they also built the Jiangsu lithium carbonate plant, rated at 17,000 tonnes per annum. When Iggy first joined Galaxy, their market cap was less than $10 million, before he put them on a path to ultimately reach in excess of $2.5 billion on merger with Orocobre. Galaxy is still regarded as the first large-scale integrated mine-to-refinery project of its kind. Importantly, when these projects were designed, built and commissioned, the lithium prices were but a fraction of where they are today. It's a testament to Iggy's ability to deliver difficult projects on time and on budget in extremely difficult markets. Joining Iggy on the board is Greenbushes veteran, Mr. Pat Galan. Pat ran Greenbushes for over 25 years and oversaw production increase from 200,000 tonnes to in excess of 1.4 million tonnes per annum. We've also got international lithium downstream technology expert, Dr. Jinwan Liu. Dr. Liu is former Galaxy and designed and commissioned Jiangsu. Introducing our Apollo exploration project. Apollo is located along the Trans-Tiger Highway in James Adina. It's been a hotbed of activity over the previous 18 months for those companies. Phenomenal drill results, now equally as impressive mineral resource estimates. Patriot coming in at 109 million tonnes at 1.4% lithium, and Winsome 59 million tonnes at 1.1% lithium. We're all probably old enough to recognise and remember the NBA Dream Team. The likes of Jordan, Stockton, Malone, Pippen, teaming up to take on the rest of the world to prove their might. Well, not one to be outdone, some 30 years later, Iggy has put together his own Lithium Dream Team. Joining Iggy, Pat and Jinwan, we've got the former GM of Operations at Galaxy, Mr. Terry Stark, Roger Pova, who ran Mount Cattlin, Hui Nguyen, who built Mount Cattlin, and John Loxton, he built Jiangsu with Iggy. He's also on the team. Our most recent appointment is the former CFO of Galaxy, John Zabulski. Stepping through what a typical lithium mine development timeline might look like, from maiden through scoping, PFS, DFS, funding and construction, can ultimately take in excess of 10 years. Let's have a look at what the Dream Team achieved at Mount Cattlin, from first maiden to first product in an extraordinary 3-year time period. How did they achieve this? They skipped scoping and PFS, ran a number of other processes in parallel, whilst leveraging an incredible team culture. Looking at what's happening further down south at Kwinana, after commencing construction in 2016, it's evident that this plant is still only operating at 8 to 10% of design. Capital cost blowouts have been experienced to the tune of over $300 million. The story at Albemarle's Kemelton plant, not much different. Construction delays, commissioning delays, and still only operating at less than 50% of design. Most recently, they had to parachute in Chinese operating expertise to help fill that gap. If we turn the page to Canada, the story stays the same. We've got Nemaska Lithium, who completed their DFS in 2011. After spending in excess of $250 million to deliver only 110,000 tonnes to market, they filed for Chapter 11 in 2015. Nemaska Lithium completed their DFS in 2018, and after spending in excess of $400 million, failed to make startup in 2019. Let's compare this to the Dream Team's track record at Jiangsu. From breaking ground to project completion and commissioning, an extraordinary 25-month period. Capital cost, more than reasonable, $120 million. The plant operated at design and delivered the highest quality lithium carbonate to market. It's evident that Canada is forcing a critical mineral strategy, mostly evidenced by Sinomine's forced divestiture from Power Metals Corp and relinquishment of their spodumene offtake agreement. Canada also has a burgeoning automotive industry. In excess of 1.6 million vehicles are exported annually. It's clear that Canada appears to be forcing a downstream solution. There is also a real lithium conversion gap that currently exists in North America. Approximately 900 gigawatts of battery and cathode factories have been announced to come online circa 2028. This will require 800,000 tonnes per annum of lithium chemicals to meet this demand. The current planned conversion capacity is only 100,000 tonnes per annum. Currently, there are actually no operating refineries in Canada and the USA. So North America as a whole has no operating refineries. In fact, 95% of all conversion comes from China, a country that North America is trying to desperately decouple itself from. So where does that leave us? We've got the government pushing a downstream requirement. There are no operating converters in North America, and there's limited processing expertise amongst junior exploration companies. Our solution is the Quebec Lithium Processing Hub. The Quebec Lithium Processing Hub is a mine to battery-grade lithium carbonate strategy, where we're going to leverage a 1 million tonne per annum multi-purpose concentrator to feed a 16,000 tonne per annum lithium carbonate plant. The ore for the concentrator, which will be based on the proven Mount Cattlin design, will be sourced from 2 spots, either our own at Apollo or by entering into 5-year joint venture agreements with other juniors in the area. This will afford them the opportunity to bring forward their cash flows and accelerate their own mine development. If after 5 years they choose to want to have a concentrator on their own site, we'll be able to do this for them, and they'll be able to become a concentrate producer in their own right. Primero has been engaged to complete the engineering study for us. They're looking at determining what the capital cost will be to replicate the proven Mount Cattlin design, but for the Canadian environment. Our 16,000 tonne per annum battery-grade lithium carbonate plant will be based on the proven Jiangsu design. Battery-grade carbonate will be sold into North American markets and potentially Europe. This will meet the Canadian government's critical mineral strategy, but more importantly, provide a real downstream solution for Canadian lithium miners. Hatched Engineering is completing the refinery study for us. They built Jiangsu with the Dream Team and are determining how much it's going to cost to replicate that design, but for the Canadian environment. We've also recently signed an option on land in Canada for our refinery location. We've chosen the Bécancour Industrial Park. It's got access to, with sealed roads, rail, and proximity to deepwater port. Made the location almost perfect. Our design incorporates that first initial train for 16,000 tonne per annum lithium carbonate, but we've also made sure we've got additional optionality for 2 additional trains to bring the cumulative total production capacity up to 48,000 tonnes per annum, to make a real dent into that 800,000 per annum conversion gap we identified earlier. We're also completing our lithium carbonate refinery test program under the guidance of Dr. Jinwan Liu. So we're conducting met testing on a number of internationally sourced spodumene samples to ensure that we're building the most robust refinery possible. We'll be able to import ore from anywhere in the world to Bécancour for processing. This will allow the Canadian market to keep maturing. So, in summary, we're looking to fill the real downstream gap, conversion gap that exists in North America. We've got the Lithium Dream Team, a proven board and management who execute difficult projects on time and on budget. And we've also got the Quebec Lithium Processing Hub strategy. So there's no better time than now to join us on our mission to build a lithium future. Thank you.
Well, thank you very much, Gernot. Right, I was discussing before about my theories on lithium and producing lithium in a decarbonised way, and mentioned that zero carbon lithium project in Europe and Vulcan. So without going into that in any more further detail, because I think I did a rather good job explaining all that away last time, would you please welcome Dr. Francis Wedin. He's a battery materials and renewable energy industry executive, and he is going to discuss the recent progress at zero carbon lithium, and there's some interesting things that may be just around the corner that could really set things off for them. So please make him welcome, everyone.
Thanks very much. Hi everyone. As I mentioned, my name is Francis Wedin. I'm the founder and formerly CEO, now the executive chair of Vulcan Energy Resources, the world's first zero carbon lithium company. I'd like to start off with this image. I think it really encapsulates what we're doing quite nicely. This is the upstream part of our project. What you're looking at here is the Upper Rhine Valley in southwest Germany bordering France. And this is our mine, just here. This is a geothermal renewable energy plant. It is currently producing, it's a commercial plant, albeit a small one, and it's currently producing the holy grail of renewable energy, baseload renewable power. It's producing that from deep wells, which have been drilled between 3 and 4 kilometers deep beneath the surface, and they're tapping into this deep underground brine reservoir. So the wells are pumping up this hot brine to the surface. It's coming up hot, 165 degrees centigrade, and it's a brine, so it's salty. We produce baseload energy from this brine, as mentioned. What we've been doing for the last few years at our pilot plants here is we've been extracting one of those salts from the brine, lithium chloride, and we've been processing that to produce a battery-grade lithium hydroxide product. And we're now ready to execute to build the commercial version of this. Critically, all of the pieces of the puzzle that we use to make that battery-grade product are in some way, shape, or form used commercially today. We're just bolting them together, and we're engineering the fossil fuels out of the lithium production. So we have 0 fossil fuels used in this process, and we actually produce more energy than we consume. So we're net energy positive. So you're looking at our resource, basically. Underneath the Upper Rhine Valley, there's this big geothermal lithium brine resource, and this is where we produce our upstream product from. A nice image to get started with. Disclaimer is available on our website. I won't go through it. Purpose and mission of the company, really, we started from 0 carbon lithium and working backwards from there. How do we decarbonize lithium production? How do we get the fossil fuels and the carbon footprint out of lithium production? Because lithium is actually very carbon intensive today. So a ton of lithium hydroxide produced today takes anywhere between 15 and 30 tons CO2 per ton of lithium hydroxide produced. If you extrapolate that out to the electric vehicles, passenger electric vehicles, converting all of the passenger vehicles in the world to electric over the next few years, which is happening, you will emit somewhere around 2 billion tons of CO2 just for the lithium to do that. That's a massive figure. That's the annual carbon budget of Western Europe. So we want to be a small part of decarbonizing the lithium supply chain. I know there's other companies doing great things out there as well to achieve this goal as well. And really, that's the core mission of the company. And once again, you're looking at our mine, which is these geothermal wells and plants. Our target's to produce renewable heat for around about 1 million people by 2030 as we expand across the Upper Rhine Valley, and enough lithium hydroxide, this is a very rough figure, but for about 1 million electric vehicles per annum. And in doing so, to avoid about 1 million tons of CO2 per annum. So there's a huge avoidance opportunity here. We think we can avoid somewhere between 50 and 60 million tons of carbon dioxide over the life of our projects as we expand. This is a good snapshot of the business here. So at the moment, we're focused on phase 1. This is an integrated renewable energy and lithium chemicals operation, producing lithium hydroxide, our trademarked 0 carbon lithium product, at the back end, renewable heat for local communities and industrial customers. And then we have this funnel of future phases that we'll be building across the Upper Rhine Valley. But in addition to being a project developer and operator as well, we also have technology in our company. So we have the technology arm of the business. Volsorb is our in-house lithium extraction adsorbent. It's a very high performance one. And we will be looking to license this out across the world as well. We also have our own in-house well delivery group as well, Vulcan, a lot of oil and gas expertise in the company. More on that later. Very quick summary on, because I don't have too much time and quite a few slides to get through. Very quick summary on, I guess, the key investment highlights in Vulcan. So we are a unique offering in the supply chain. So the world's first and only 0 carbon lithium company. We have a very large lithium resource, the largest in Europe and globally significant, 27 million tons of contained lithium carbonate equivalent. We have very strong contracts, very strong relationships with lithium off-takers. So we have tier 1 customers, Stellantis, Volkswagen, LG, Umicore, and Renault, really supplying the top-level automakers and battery manufacturers and cathode manufacturers in Europe. We have a low cost of production, so very important in a volatile lithium market. On the one hand, we've got off-take prices baked in with our agreed off-take agreements. On the other hand, we have a low cost of production as well. We've got very strong tailwinds behind us in Europe. So Europe is really pushing, like other jurisdictions we just heard about in North America, to secure some measure of supply chain independence for critical raw materials. And this is really giving us a strong regulatory tailwind. We have this large development pipeline, as mentioned. It doesn't stop at phase 1. We can grow as the lithium market in Europe grows. And we have a very strong management team as well, coming from mostly the oil and gas industry and the chemicals industry in Europe. So very strong industrialization expertise there. We are dual listed. So we're listed in Australia and we're dual listed in Europe as well on the prime standard of the Frankfurt Stock Exchange. Stellantis, the automaker, is our second largest shareholder. Why do you need lithium in Europe? Well, Europe needs a lot of lithium. It needs it very quickly, and it doesn't have any. So there are a few converters being built, but there's essentially zero raw material supply coming locally in Europe. And if you're looking at what is now considered normal, when I started in lithium, hard rock mining was actually considered suboptimal compared to brines. But if you're looking for a hard rock mine in Europe, it's difficult. It's difficult to permit. I think hopefully some of them will get up and running, but it is socially harder to permit hard rock mines in Europe. Also, Europe wants sustainable lithium. They don't just want a lot of lithium, they want sustainable lithium, and they want this very quickly. So that's where we come in. We can scale up quickly, we can produce sustainable lithium, and we can reduce reliance on external providers of lithium hydroxide. In addition, we are a renewable energy producer right now, and we're building a lot more renewable energy production. And guess what? There's been an energy crisis in Europe since the invasion of Ukraine. Europe is trying to decarbonize, but it's also trying to get energy security as well as critical raw material security. So we have another product that Europe desperately needs: baseload renewable heat and power. And heating is really the elephant in the room in terms of decarbonization. Easier to decarbonize power. This is what we're building. Essentially, it's an integrated oil and gas project without the oil and gas. So you've got the wells and the pipelines in the upstream pumping that hot brine to the surface, as I mentioned. We've got our geothermal plants on the surface. We're building a larger one nearby. So we'll be producing heat and power from this geothermal plant, as we're doing now. Then we have the lithium plant on the same site, which we're building as part of phase one, using the waste heat from this geothermal process to drive that lithium extraction. Then we're producing the salt, which gets transported upstream to our conversion plant in Frankfurt, where we produce the lithium hydroxide. And phase one, capacity 24,000 tonne per annum. Each phase after that, the idea is the same size. We add further phases of production, but starting with phase one. This is where we are. So this is the Upper Rhine Valley. This is the reservoir you can see in sort of golden orange there. We're starting in the core of the field where we have existing wells which are pumping this brine to the surface. We're adding more wells. And we're really starting in the core of the license area because we have that existing infrastructure. But the goal is to step out from there. You can see it's a very large field and we see multiple phases of production ahead of us. And there you see in the downstream, that's where our chemical plant is. So instead of transporting the lithium chloride for thousands, tens of thousands of kilometers, we're 130 kilometers up the road, the upstream and the downstream, very close to each other, reduces costs, reduces carbon footprint as well. Very well understood system, decades of oil and gas and geothermal production, which has given us a lot of data and a big head start in the project development. So we have multiple phases ahead of us beyond phase one, and this is phase one just in the center as well. So if you cast your mind back to that previous page, it really makes up a small fraction of the overall field. So starting with the wells and the pipelines, you can see once again, very analogous to that upstream, downstream oil and gas style project. And that's why we have a well delivery group in-house, 100 drillers coming from the oil and gas industry, looking to use their experience to build a renewable energy and decarbonization lithium chemicals project. So that's Vercana, our in-house well delivery group. They've been working in this area for many, many years, drilling oil and gas wells as well as geothermal wells as well. We have 2 rigs in-house. This is one of them here, which we've been refurbishing for the last couple of years as well. So we have the project execution ability, and we're going to be drilling really for the next decade, we see, as we build further and further phases. The geothermal plant, we're building a bigger version of this one. It's off-the-shelf technology. In terms of the lithium extraction plant, well, this is a mini version of it. So we built a commercial demonstration plant. This is about a 40 million euro investment. This is what we call LEOP, Lithium Extraction Optimization Plant. This is a training facility. So we'll train our production team here in a pre-commercial environment whilst we're building the commercial plant. We've already done the piloting. That's been done over the last few years. This is the optimization plant. This is the training ground for our production team. So production team is already there. This will start to produce product hopefully in the next couple of weeks. So we're getting very close here to first product from this plant. We had a grand opening ceremony late last year, which was well attended. And this is what the commercial plant looks like. So we'll be building this in an industrial park nearby. We always place ourselves in industrial parks. We're not sort of breaking any new virgin ground. We're not chopping down any trees. This is all within existing chemical parks and industrial parks. So once again, minimizes the carbon footprint. In terms of the lithium extraction, we're using this. We call it Vulsorb. This is technology that has been used commercially since 1996 to take lithium out of brines using a process called adsorption. It was invented by Dow in the 70s, so it's been around for a long time. It's a lot older than me. We use this commercially proven technology. We've adapted it, we've iterated it, and we think our sorbent is one of the highest, if not the highest, performance sorbents in the world. So we do want to spec this out as well because we think it's a really good product. But this will be used for our phase one, and we're using a toll manufacturer to make it for us in France. Once again, onshoring the supply chain in Europe. So the main advantages of this process relative to some of the other methods that are used around the world, you hardly use any reagents. It's highly selective, it's very, very efficient, you can produce very, very quickly, and the main input is heat. And we have waste heat coming from the geothermal process that we can utilize, and that drives down our cost of production. So this is unique intellectual property, unique IP, and it's in-house to Vulcan. It's a real value that we have. This type of process is used globally today, makes up about 10% of global production, or about a quarter of production coming from brines today. But the rate of adoption is increasing because of the aforementioned reasons. So in places like South America, in China, in North America, increasingly you're seeing adsorption style projects being built. So this is the future. The unique advantage that we have, though, is that we have the heat to drive it. You'll see oil and gas majors also getting into the space, including Exxon in the US and Oxy as well. So this is a really interesting space because oil and gas and mining are somewhat intersecting in the world of lithium. The last step of the process, the central lithium plant, same thing again. We built a commercial demo version. Got that? 1.5 minutes to go. We built a commercial demo version. It's going to train the production team. And we've already done the groundbreaking ceremony. This is where it is. It's in the Herx chemical park, existing chemical park that's been around for over 100 years, and essentially using chlor-alkali technology, electrolysis cells. They've been doing chlor-alkali here for over 100 years as well. So we have all the expertise, including from BASF, to run this. I'm going to have to go through the remaining part very, very quickly. We have a tremendous decarbonisation opportunity. You can see the delta there with current supply, but we're also very, very low cost because we're using that waste heat to drive the process. So in a volatile lithium market, I would argue that we represent a safe harbour for lithium production, given that we are very much lowest cost quartile. We also have these tier one off-takers that we're selling to as well. So binding lithium hydroxide off-take agreements gives us certainty on pricing. That gives us very attractive economics. So 2.6 billion euro post-tax just for phase one. Remember, this is phase one of multiple phases of operation. This is what we're in the midst now in the trenches of financing. So, and you can see it goes from a renewable energy dominant project to a lithium dominant project. Over 700 million euros of revenues over the project's life on average. We're now in financing, and we're really going to be focused on this for the majority of the rest of the year. So we're financing phase one. We've got some good tailwinds there. We just announced backing from the European Investment Bank, and we're looking to finance this at a project level, not at a topco level, obviously to reduce dilution for our shareholders. That is our target. I'll have to stop there. In summary, ready to launch. We are execution ready. We have the execution team in place, the production team in place, nearly 400 employees in the company from well delivery to final production. And subject to financing, we are ready to go with zero carbon lithium. Thank you very much.
Thank you very much, Francis. Race to the end, but it was worth it. Remember, always going to see them at their booths. Now, this next one is interesting, and it's a relatively new player in this sector. They rang the bell in January this year. They had an oversubscribed IPO, Kali Metals, and they've established a significant lithium exploration package in the Yilgarn and the Pilbara regions of WA, and also over in a place called the Lachlan Ford Belt, which is in New South Wales in Australia. Their focus since listing has been on its Higginsville Lithium District, which is located in a region where the major shareholder, which is Mineral Resources, has built a very strong foothold. Now, this fellow here is Graeme Sloan. He is their MD as a previous director at Karora Resources. So he's become very well credentialed to this role. He's going to tell us a little bit more about what's happening with Carly's lithium project, including, I would suggest, an announcement that was made this morning. So we're going to be the first to hear about that in detail. Would you please make him very welcome?
Thank you, Kirsty, for doing such a great job keeping us all in line. I really appreciate it. Also to Stewie and the Tribeca gang for putting on this conference. Really great effort, and it's a pleasure to be here today. Certainly been a journey for us, been a very interesting journey in a very short space of time. Before I begin, maybe just a quick snapshot of Carly, who we are. We're a lithium exploration company. We began the journey in sort of early January 23, sorry, and in January the 5th of this year, we listed on the IPO. Probably the first, not probably, the first IPO listing on the ASX exchange. So we came about by the formation of the lithium assets from Kalamazoo Resources and Karora Resources, Karora being a TSX-listed company, Kalamazoo being an ASX-listed company. As I said, the journey started in early 23. 24, we listed, we raised some $15 million at 25 cents. We were heavily oversubscribed. We opened and closed that offer within a matter of hours. So as I said, now we look to put that 15 million to work very quickly. So just quickly on this, obligatory disclaimer, urge you to read. Really, we need something to sort of stand out, make Kelly stand out. What's the one thing or two or three things that are going to get you interested in this Kelly story? Well, firstly, we have a massive land position. We have some 4,000 square kilometres of land tied up in 3 major project areas. Give you an idea of what that means, that's about 5 times the size of Singapore. So it's a big chunk of land out there, and it gives us optionality. 2 of our 3 projects are in the hottest lithium provinces in Australia, both in the Pilbara and down south in Eastern Goldfields. Our 3rd project is over on the east coast in the Lachlan Fold Belt. As I said, following that IPO, we had the funds. We're fully funded for 2 years of exploration. And pre and post IPO, we had a number of partners and key investors. And certainly we had our SQM JV, where they have the opportunity to acquire 70% of 2 of our 3 Pilbara projects by spending 12 million over 4 years. So that's, and then post IPO, we're very fortunate to bring Mineral Resources onto the register at 14%. And we certainly have the team. We have this great team, both at a board level and also exploration. I know people talk about everyone's got a great team, but I'll tell you the secret of any successful company, and that is that team has to be willing to go out there and put everything on the line to make things happen for the investors. And I believe our board and our executive team certainly have that. Very quickly, a snapshot on our, just a corporate view, if you like, 144 million shares on issue, market cap of around $60 million, EV of around $45 million. Major shareholders, Karora, who was, as I said, partly due to forming Cali, 22%, Kalamazoo 20%, and then Mineral Resources with 14%. Board and management have around 11% on a fully diluted basis, and the top 20 own 71% of our register. Board, very solid board, very solid exploration, executive team, as I said. Board's led by Luke Reiner, and a lot of people may know Luke in this audience. The 3 assets themselves, there they are. On the left is our Higginsville, Middle Pilbara, and then Lachlan Fold Belt. Higginsville, as you can see, lots of pretty colours up there, divided into 8 areas because it's such a very large tenement package. It's some 1,500 square kilometres of tenements. We had to divide that up into 8 areas so we can make exploration more efficient, which we only worked on now so far 2 of those projects, one up in the top of that up there called Spargoville, and just south of that is our 2nd project area called Widgie Miltha. That area there, those tenements completely surrounded by existing mines and advanced lithium projects. To the north, you have Mount Marion. Over to the east, over here, you have Bald Hill. Down south, Buldania, also Mineral Resources acquired 100% of Pantoro's tenement, lithium rights down here. Pioneer Dome, both Mount Marion and Bald Hill operating processing plants as we speak. The others are certainly well advanced, including up north of Bald Hill being the Manna deposit. So as I said, completely surrounded. We're a bit like Custer as was in The Last Dance, surrounded by Indians, and I'm telling you, this is going to be a great story when we start putting some drills in the ground, and I'll talk about those in a moment. Pilbara, 3 project areas up there, Doms Hill, Pear Creek, and then Marble Bar. Doms Hill, Marble Bar are subject to that SQM JV, surrounded by very good infrastructure, only an hour from Port Hedland. And the same as here, we're very good infrastructure in and around Higginsville. So when we start talking start-up mining and those sort of things, then it's very quickly, very simple process for us to do so. Our third project, emerging province over here in the Lachlan Fold Belt, we have 2 areas, Jingellic in New South Wales, Talangata in Victoria. Again, a big area, 2,000 square kilometres. A bit more on the projects themselves. Well, Higginsville up here, this is our first area we've gone into. We did some surface work, some field work, we rock chips, we've done some soil samples, and we announced sort of around a month ago this very large anomaly, and sitting over the top of that is some big numbers around the rock chips, around 5% lithium oxide. The most important thing about this is they coincide sitting on top of this soil anomaly. As Christy pointed out, we made an announcement this morning, and part of that was in fact to see those anomalies start to expand quite considerably. If I go back to that first one, you can see over here what was just a bullseye, a hotspot over here, very small surface soil program was put over that, it lit up. We had some good chip samples here, but now when you start seeing that, you can start to see all up. Those 2 anomalies are about 5 kilometres in length. So these we're not talking sort of small size, these are serious sort of targets for us. We'll look to start drilling in early, probably this first half of this year. In fact, given the results of this, we'll bring that drilling on a lot earlier as soon as we can. Again, we've expanded our soils program to cover this and all the other remaining 6 project areas at Higginsville. At Widgie, another sort of significant anomaly sits there, over 900 metres long. It's only sort of about 20 k's from Spargoville, so it's very close. Again, good numbers, plus 2% rock chips, again correlates well with the soils. Mount Henry, early days, 1% down there of initial rock chips, so tells us we're in the right area. Pilbara, as I said before, 2 of our projects, this one here, subject to the SQM JV. All the money that we raise from that IPO will predominantly go into Higginsville and a little bit over to the Lachlan Fold Belt. This is fully funded by SQM. So we manage the project, but we are fully funded by SQM for the next couple of years there. They've currently earned around 30% by spending some $2.5 million. Close to some major mines in there. This is really the land of, what I call the land of the giants. It's the big deposits up here. We've seen Pilgangora up there, we've seen Wodgina up there, sort of 300 and 250 million tonnes, those sort of numbers. So this is big country up here, and we sit dead smack in the middle of it. So looking forward to doing some more work up there. We've done some sort of surface work in and around here. We've done some small drill programs up here. The results of our latest geochem will come out shortly. And some of the field work down here has been along the lines of surface rock chip samples and looking at a lot of those outcropping pegmatites. There's one in particular that goes around 1.2 kilometres long, and I think there's about 4 samples spreading over somewhere between 2 and 2.8%. So looking forward to doing more work up there, and our geologists, I know our geologists are quite excited. Lachlan Fold Belt, as I said, emerging, new province. Look, all I can say is that we've been fortunate. We've been in there first. We're the second company up there. We've been able to pick up a lot of ground up there, over 2,000 square kilometres. That blue area you see up here is recently added to the Jinjalik. It now makes all those boundaries contiguous. We've done some soil work and we've done some rock chips up there. We've certainly seen that there's LCT pegmatites up there. It's now, we'll do a bit more soils. We put a hole in there and we hit what we think we might hit. And I'm telling you, this is going to be the next lithium hotspot in Australia. We will see a mini rush into this particular area. So still early days, but hugely exciting for the company. So look, I'm very, very conscious of Christy. She's got this vicious bump if I was to step over the mark. I'm going to finish early. I'm going to make sure that I don't get that bump or get bumped off. But the key takeaways to this, as I said to you, there's no other company in Australia that has the land package we have. It is such a big land package. It gives us optionality around exploration. It gives us optionality where we put our people, our best resources. And at the moment, Higginsville appears to take that point, mainly because that's where most of our funding will go. We are well funded. 2 years fully funded for the next lot of exploration. We have delivered results. We will continue to deliver the results, as you can see from that last ASX announcement, and we have the team. So given those things, the asset, the team and the funds, that's not a bad start. And I think in a very short space of time, I hope to be standing up here, tell you that we've drilled a hole and we've been highly successful and a lot of money to investors' pockets. So thank you very much.
Great presentation. Thank you very much, Graeme, and impressive that you can keep to time. If you can keep to time there and keep your promises, I'm sure you'll be keeping them all over the place. Australia to Canada, NexGen Energy, a Canadian exploration and mining company dedicated to advancing the Rook I project. And I'm going to guess that many of you have heard about this, especially in the last few weeks. Now, that project is poised to deliver 25% of the world's current uranium demand, directly addressing that growing expansion of nuclear energy worldwide and its role in achieving net zero. So the news flow since late last year has been rather prolific, and in the last few weeks, even more so. So we're going to hear from the team itself. This is Stacey Golokin. She is the Director of Investor Relations here in the Asia Pacific markets. And she's joining us to elaborate on why it is that this company is making so many headlines, and should we be interested? Please make her welcome.
Good morning, everyone. So there lies a big opportunity for NexGen Energy, especially given the growing critical need for uranium against a backdrop of a widening supply-demand gap. Now, before we begin, please note that I will be using forward-looking information and making forward-looking statements throughout this presentation. So, as we've all observed, the support for nuclear, particularly over 2023, has been dramatic. There continues to be positive, unrelenting news flow in favour of this energy source, as more governments and industries consider nuclear the solution to the climate crisis and the energy crisis. Geopolitical situations worldwide have also accelerated the path for governments to include nuclear or feature nuclear as a prominent part of its energy diversification and energy security strategy. So demand for nuclear and subsequently uranium is very robust worldwide, but the supply situation grows increasingly precarious. Now, where does NexGen Energy fit into all this? We are a Canadian uranium exploration and development company. We're triple listed on the TSX, the NYSE and the ASX, and our flagship asset is the Arrow deposit at our Rook I project. Now, Arrow has been described as a geological phenomenon, and it has been recognised as the world's largest, lowest cost, high-grade uranium deposit under development. Now, the project is located in one of the best sovereign locations for developing a uranium mine, the premier mining-friendly jurisdiction of Saskatchewan, Canada. NexGen has a significant land package spanning 190,000 hectares in the southwest Athabasca Basin, which is an area known to be super rich in uranium. Now, the project is in the final stages of the federal approval process, and once in production, we're going to be able to produce up to 30 million pounds of uranium, with our mill permitted for 24 years. Now, 30 million pounds annually is up to over 50% of global Western supply and up to 25% of total global uranium supply. Now, to put that into perspective for you, Saudi Arabia, they're responsible for producing 8 to 10% of global oil supply. They're very influential in that market. So when Arrow comes online, we'll be very disruptive and influential in the space. It is a massive project that will help fulfill some of today's supply gap, but it's not going to be enough. So I know a few people have touched on this over this conference, but I think it's important to stress the gravity of the situation. So demand for uranium is expected to increase 127% by 2030 and 200% by 2040. This is a massive increase that the industry cannot meet in time. And you know, it's a situation that the industry has never seen before, with the current state of mine supply having never been more fragile. Many multiples of Rook I's annual production will be required to meet this forecasted supply gap. And that's why projects like Rook I and others must be brought online and into production. And what's driving demand? In December last year, a pretty remarkable thing happened at the COP28 event, where we saw 22 countries sign a declaration to triple nuclear capacity by 2050. That number has now grown to 28, and it was the biggest endorsement yet of the role that nuclear energy will play in the energy transition away from fossil fuels. So you'll continue to see many more supportive policies come out of the EU, the US, the UK, and Japan. Countries will continue to apply to extend the lifetime on existing reactors, embark upon refurbishments, capacity increases, and then there's demand from the advent of small modular reactors. Worldwide, there's currently 60 reactors being built in over 17 countries. A further 110 are planned. That number also does include India's latest news, where they've said they're going to add a further 18 nuclear builds to their nuclear build-out program. So the demand from these emerging economies alone is enough to keep this market really tight till the end of the decade. We are in a period of significant nuclear investment with no signs of slowing down. On the supply side, supply is entering a challenging period for the foreseeable future. Post-Fukushima, there has been massive underinvestment in exploration and mine development all the way up until 2020, which really wasn't that long ago. Restarting idle mines are proving challenging because the cost to produce a pound has increased. Major producers are supply constrained. There's scarcity of new mine supply, long lead times on greenfield projects due to the complexity of permitting a uranium mine. And then you've also got geopolitical issues, the Russian uranium import ban that's looming in the background, the bifurcation of markets as more people seek for diversified Western supply. Now, NexGen, because of our technical setting, we have extremely low costs. And as a result of our technical setting, we're able to flex production up and down in line with market conditions. This means that we are able to and will use volume-based contracting referencing spot prices at the time of delivery. This approach will maximize the dollar received on every pound produced. And this approach will be new to the industry and will provide transparency and promote resiliency of the uranium supply chain. So I mentioned our low costs before. We have a low all-in sustaining cost of US sub $11. Now, based on the 2021 feasibility study, at a spot price of US $100 a pound, we'll generate some pretty compelling economics. We will generate $8 billion NPV Canadian, over $2 billion in free cash flow, a sub 82% IRR, and a very quick payback period of less than a year. So some really incredible numbers here. Now, because of our low costs, we go into production under any pricing cycle, and we're highly cash generative in all pricing environments. Even if you do not agree with the spot price trajectory, we will still be making billion-dollar NPVs and billion-dollar EBITDAs, as we've got great downside protection from our low-cost profile. So, as for our expansion potential, note that the darker green bars here cover our measured and indicated, that's in our feasibility study, of 260 million pounds at 3.1% grades. Over 60% of our measured and indicated is at 17% grades, which is 170 times the global average. The lighter green area on this graph represent our 81 million in inferred resources, which are around 1% grades, and adding value through our drill bits. So earlier this year, we announced our 2024 exploration program, where we said we'd drill 30,000 metres with the objective of finding new Arrow-like discoveries. And a couple of weeks ago, we released a pretty exciting news release where we hit intense new uranium mineralisation 3.5 kilometres away from Arrow. And while it's still early days, it's looking like the results of that extremely promising with double-digit grades. So 30 million pounds of uranium a year. What does that mean from an environmental ESG perspective? That's enough to power 46 million homes. That's a third of the homes in the US. So that's all the homes in Florida, Texas, Pennsylvania, New York, and yeah, I think that's it. And we'll do that by also removing 70 million car equivalents of CO2 a year. So that's over 300 million tonnes of CO2 avoided annually. It is an amazing project, and to the best of my knowledge, no other resource project will be as impactful as Rook I. So where are we at with our approval process? Well, last year in November, NexGen received their provincial environmental assessment approval. This is huge because we're the first greenfield uranium project to have reached this major regulatory milestone decision in Saskatchewan since the 1990s. We're the first greenfield project to have been approved that is 100% independently owned, non-government owned, and it's also one of the most efficient approvals with respect to cost and time. Now that we have our provincial environmental assessment approval, we are laser focused on acquiring the federal approvals required for the project, and we will have an update on that this year. Now, our project also has industry-leading impact benefit agreements signed with all of the Indigenous communities local to the project site. This is unheard of in mining, and it's something that the team is so incredibly proud of having built. And as a further testament to the trust and collaboration built by the team, Indigenous leaders from these groups have also been proactively advocating for our project in the federal government of Canada and the Saskatchewan Parliament. That is also unheard of in mining. So, at a $100 spot price, based on free cash flow, we will generate $1.6 billion US. That will place us in the top 10 mining companies of the world. Now, we think that the spot price will move beyond $150 a pound. And if we look at the last spot price run in the 2000s, it hit a high of $135, $140 a pound, which in today's dollars equates to about $200 a pound. Now, the difference between back then and now is that a lot of the major producers back then are either no longer in existence or they're already supply constrained. And so beyond $150 spot price, we'll be in the top 5 mining companies of the world. As for our capital structure, we currently have 410 million cash on hand, with the exception of some G&A items. Every dollar spent going forward will be on project capex and working capital. Now, in terms of financing, we have several expressions of interest totaling about US $1.25 billion from traditional lenders, international lenders, and export credit agencies that are all very motivated to invest in an elite ESG project. As for our executive and leadership team, they're very experienced and entrepreneurial, and it's not just our leadership team that are really determined. That determination flows through the whole team, the whole company, and as a result of our collective culture, process, and execution, we have achieved one of the most efficient approvals with respect to cost and time. Again, we have a highly credible board with deep expertise through a dozen subject matters, and with their guidance, we're well placed to navigate the dynamics of the uranium market sector while safeguarding the interests of our stakeholders and shareholders alike. So I've shared a lot with all of you today. It's going to be a very busy year for NexGen for 2024 as we look to establish our federal approvals hearing date, complete our site infrastructure program, award our shaft sinking contracts, commence major construction, all while in parallel running our 2024 exploration program. I thank you so much for your interest and your time, and if you have any questions, please find me around the conference. Thank you.
Thank you so much. Right. Is anyone else having any issues with the Wi-Fi at all for the future-facing commodities site at all? You're all okay? I just want to check in because we're having a few, and if you have, please give us some feedback and we can fix it up for you. Wayne Heili. Here he comes. Right, so as the world embraces this nuclear power for a clean energy future, it becomes increasingly apparent that we need to source uranium from tier 1 mining jurisdictions. And Peninsula Energy, who's coming up on stage now, operates a world-class, long-life, low-cost asset, which is based in Wyoming in the USA. So this is their company's CEO and MD, and Wayne has committed the last 35 years of his career to process innovations in the uranium industry. He held numerous engineering, management and executive positions, and today he's going to tell us all about the future for Peninsula Energy and inspire you to perhaps jump on board. Welcome, sir.
Thank you. I'd like to start out by saying I think if you're going to have a great uranium development project, you need to have a weapon-based name. We just heard about Arrow, and I'm going to tell you about Lance and our other project, Dagger. So we are in good shape here. Peninsula Energy has or is on track now to become a uranium producer at the end of this year in a world-class tier 1 jurisdiction, the state of Wyoming. We're an ASX-listed company with US-based assets, and it's very pleased to be here today presenting to you. Again, all the disclaimers are standard. I do tend to speak with forward-looking statements, and I caution you on that. Today, what we're looking at with Peninsula Energy and the Lance projects is a world-class, scalable, near-term uranium production story in a tier 1 jurisdiction. We are on track for production at the end of 2024, and we funded that. We're funded to production. We'll be looking over the course of this year to secure additional funding to take us from and through the ramp-up phase to the point of being cash flow positive, which to me is a mark of a mature uranium company or any company being cash flow positive, producing enough product to support all of your activities and providing a return for your shareholders. We know, with certainty that we're facing a very favorable uranium market now, and it looks to be that way well into the future. And with that, our developments at Lance are providing us multiple avenues of growth, exciting opportunities to expand the resources within the Lance projects at the Kendrick and the Barber areas, and then at our Dagger project, which is adjacent. Today, our corporate situation is like this. Our market cap sits at about $253 million Australian. We have about $58 million US in the bank today. We're well funded for our programs, and we have no term debt. A very experienced board of directors who's been with the company for a long time. And we also have a very experienced management team. But to answer the question, how did we come to be so well funded to have $58 million in the bank today? What we did was we just completed an equity capital raising in November of 2023. With that capital raising, we did a placement of $50 million Australian, and that was followed with a share purchase plan for our existing shareholders, taking good care of them, a $10 million raising. Attached to those shares was options, half options, and those half options are in the money with a strike price of 10 cents per share. They have a short-dated tenure that the options expire within a year, and that was all designed so that we could possibly see another $40 million of revenue from the option exercise over the course of the next year that will continue to bring funding into our company. We're also pursuing loan programs. We have a loan application being considered by the U.S. Department of Energy that would provide additional funding for the company and carry us through the ramp-up period of production. And we're talking to other non-bank debt providers as other options for funding. So we're not excluding equity, but we're looking at debt funding for the balance of our capital needs. That's our priority. Our production team is second to none in the United States. As introduced, I have over 35 years of experience in the uranium production industry in the U.S. I'm second to Mr. Ralph Canode, who's my project manager at the facility. He has 45 years of experience. Collectively, with some of the younger guys each having over 20 years of experience, this team that we have in place has over 200 years of direct production, construction, and operations experience in uranium mining, and we are the envy. This team in the United States is just one of the top uranium production teams. So I'm really pleased to be working with them, and I know that they will successfully carry the project forward into production in the coming year. Let's talk about the project. It's situated in the state of Wyoming. The Lance project is in the Powder River Basin, which is a prolific uranium production district. You could see on this map the number of uranium mines and development projects in the Powder River Basin and around the state of Wyoming. Wyoming is a mining state, in case you didn't know, leading the nation with coal production, uranium production, trona, and one of the leading producers of oil and gas in the United States. The people of Wyoming understand extraction. They support the extraction industry, and we really have virtually no local opposition when we do our regulatory work. That means that the Lance projects are fully licensed for production. We've had our license since 2015, and I'll tell you a little bit more about the history of it, but the Lance projects are broken down into 3 areas. The red area that you see here is the Ross production area. That's where we started production in 2016. We have 2 fully developed well fields that will return back into production when we get going again. We have a process plant that we're expanding today. I'll tell you a little bit more about that in this presentation. And then we're going to look to expand our production out into the Kendrick area, the area in blue. The Kendrick area has about 16 million pounds of uranium resource to add to about 7 million pounds that are still at Ross today. Between those 2 areas, we project 10 years of mining. The next 10 years will produce over 15 million pounds just between Ross and Kendrick. And then we have the most exciting aspect, for explorationists is the Barber area, the area in green. Today we know there's over 32 million pounds of resource. It's mostly inferred resources, and that we have a lot of work to do to infill drill and bring closer space drilling to the project area. We know that there's a tremendous resource expansion opportunity there. But today we sit with a world-class project in the United States with over 50 million pounds of resource. When we continue drilling on the project, we think we can bring that resource up, very much a forward-looking statement, to between 150 and 200 million pounds. Again, making this one of the most exciting and most substantial uranium project developments in the United States. We use and employ a low pH in situ recovery process. In other words, acid leaching with solution mining. This is how the Kazakhs and Australians produce their uranium by in situ methods. It's very well understood, ecologically friendly approach to uranium recovery. We only have temporary surface disturbances. We add a chemically fortified solution into an aquifer that dissolves the uranium. We recover that solution and then the uranium from that solution at our process plants. It's a very simple, elegant mining process. It does not require us to move ore. We don't have open pit or underground mining facilities. This is what our mine looks like in the picture on your left, the in situ well field. Each of the little black dots you see in that field is a cover over a production or an injection well. But that's what our mine looks like when it's operating. Inside the plant facility, we have ion exchange columns. They look like this. We're expanding our ion exchange system now. Again, this project was licensed and developed in 2015. We have a capacity or a permit to produce up to 3 million pounds per year. And it was operated from 2016 until the middle of 2019 when the uranium markets did not support the project at that time. Today, the projects are quite different, or the economics and uranium markets are quite different. And we're happy to be moving forward with development activities again, transitioning to the low pH chemistry, which was completed in 2023. But more importantly, When you want something done right, you have to do it yourself. So we're bringing some of the additional processing in-house. We're preparing our plant facility so that we can do the elution, precipitation, and final dry yellowcake processing so that we produce a final dry yellowcake. In the past, we relied on a third party to do that work for us. So part of our plan, and really the focal point of our plan in 2024, is to build the new plant facilities so that we can produce a finished product ourselves in-house. And so we have construction going on. That's the exciting thing. You see in the upper picture here, folks a week and a half ago putting up forms for pouring concrete. I'm told that tomorrow we'll be pouring a significant amount of concrete slabs for our future facilities. We completed the low pH transition work. You see the acid storage and distribution facilities in the lower picture, and some of the reworking of the plumbing inside the existing plant to be compatible with low pH. We'll be commencing the significant part of our construction project in the coming weeks. We have the bid process out for the construction companies right now to build the plant facility. We expect to select a contractor in the coming week or two, and then we'll be off and running constructing the project. While we do the plant and the plant construction as maybe the focal point of the year, we're also constructing new well fields and getting new well field areas ready for production so that in 2025 we can have a very robust production profile. Preparing new well fields in an in-situ recovery facility is like stripping topsoil and overburden in an open pit mine. You have to get your mine areas ready for production. We have a high degree of focus on that this year. We're spending an equal amount of money on well field development as we are on plant construction. So, the work programs this year are very significant, but 2025 will be a real exciting year. This is what our timeline to production looks like. Today we're getting ready to select our construction contractor. We expect construction to start in a couple of weeks, directly after selecting the contractor. We do have some pre-construction activities going on now, as I showed you. We have resource expansion drilling plans for this year as well in the Lance project area and also at our Barber project, which is just to the northeast of Lance. And we're going to continue to prepare to ramp up production. We think pre-production flow and operational activities will start in the third quarter as the plant construction nears completion, and we expect to be in production around the end of this year. First delivery of dry yellowcake from our new and expanded facility will happen in the second quarter of 2025, and we'll have the project achieving sustainable free cash flow in the third quarter of 2025. So it's just around the corner for us. We have a lot of work in the work programs in action right now. Very active site, over 45 employees working, and numerous contractors. Our all-in sustaining costs when we're up and running has been projected to be around $42.50 a pound. We think an average realized price of $67 a pound is realistic. The market has improved, and we'll see a better average realized price on the basis of the improved market. But this is exciting economics for us, justified production. This is the production profile that we look at for the next 10 years. Next year, 2025, we think we'll be producing about 1 million pounds, 1.1 million pounds. And then we're going to ramp this up to about a 2 million pound a year production rate by the end of the decade. This reflects the first 10 years of production. We'll expand into the Barber area. Again, this was just the Ross and Kendrick areas. And when we expand into the Barber area, this won't be a 10-year mine life. It'll be a 20 or 25-year mine life. It's a very significant uranium resource. We have offtake contracts. We have committed some sales into the next 10 years. So against that production profile, this is our sales profile. In the dark green bars, you can see how much product is committed into sales agreements. This gives us certainty of pricing, but you can also see how much additional production is available for sale. The gray bar on top of the darker green bars show what's available for sale into the market. So we have very strong leverage to the upward trajectory of the uranium price. But at the same time, we have very good certainty on known revenues from contracts. We have 6 customers, utility customers in both the United States and Europe supporting our project. So we're an emerging near-term producer, exciting news flow this year, initiation of plant construction, development activities in the well fields, and most importantly, the start of production at the end of this year. So I hope you'll follow us and see how we achieve this. Thank you. Right on,
Thank you very much, Mr. Heili. Look forward to going out and having a chat with you more about that one in detail. Uranium's certainly been the flavour of the month. Go that way. We've got this black hole at the back of our stage, and I'm fearful that I will lose one of the presenters at one point in time over the next few days. Ah, you're over there, sir. Come and join us on stage. This is James Posnay, everyone. Well-respected gentleman, General Manager of Listings with the ASX Limited. Now, as you're making your way up, I just wanted to point out to people, because lunch was so delicious yesterday that a lot of us came in very, very slowly after lunch. So today I'd like to suggest that you grab your dessert and bring it in here and enjoy it, because we have a really interesting talk straight after lunch. I've got the team from Fortescue in, and they're going to talk not just about mining, but also technology and development. And they've got a world first to announce that I'm sure you'd like to hear more about. So that's coming up straight after lunch. And to find out about it, you have to bring your dessert in, and you can sit and listen. So James, big career, lots of things going on for you, but today you're going to use all of those years of knowledge that you've had accumulated, and you're going to talk to us about the ASX, APAC's globally connected stock exchange, and you have 15 minutes to regale us and inform us. Please make him welcome, everyone.
Great, thank you very much, and thank you to Tribeca for the opportunity to speak today. It's wonderful to be back in Singapore. We make the trip up here for various reasons, and this is a very good reason to be here. I'm going to talk today about the ASX market, what it looks like in the global context, global capital markets context, and then also talk about why it's the leading stock exchange for resources and mining. So first of all, it's quite an active market. So ASX is quite active in terms of capital raisings. Importantly, in terms of number of listings, we do about 120 a year, which puts us sort of in the top 10 exchanges by volume. We also have a long history of supporting junior mining companies. I mean, we listed BHP 140 years ago, and we've listed lots of junior mining companies and larger mining companies ever since. So it's got a long history of supporting early stage companies, and that's also translated into other sectors like technology and healthcare over the years as well. We have robust regulation in Australia. I would say it's not as burdensome as some major markets like the US, but we don't have a junior market model either. We have a main board only. So it's robust but balanced regulation. Got 2,000 listed companies, about 230 of those are foreign companies, actually, as well. So, you know, roughly sort of 10% or so cross-border companies listed on ASX. And it's a liquid market, $8 billion traded daily, which translates to roughly sort of 80% of the market is turned over by market cap in any one year. And most importantly, we have the 5th biggest pension market globally in Australia. So it's about $3 trillion under management currently, and is projected to grow, as this slide will show, to $9 trillion by 2041. Now, this is an incredible asset to have as a country. It provides extremely strong tailwinds for the equity market, and will continue to do so. The other feature of this is we have the highest allocation to equities of any pension market of any country. So it's about 51% of all of the assets under management allocated to equities. So again, that really supports listings. It was a quiet year last year globally for IPOs. So 120 on average we get per year. We had 45 last year. But that was also the case globally because of the macroeconomic conditions. We do definitely see the IPO market coming back, though, certainly in towards the second half of this year, and then into next year. But more importantly, I would say in terms of capital raisings, ASX is #1 in the world for follow-on offerings by volume, and has been for the last 6 consecutive years. So this is not always that well known. And in terms of value raised through follow-on offerings, we're more than double Toronto on average, just a little shade under double for last year, but also ahead of Hong Kong for follow-on offerings and capital raisings. So we're really quite proud of this, and this is actually 2 things. On the demand side, obviously you've got the assets under management in Australia, the large pension market and so on, giving those tailwinds for the demand side locally. We also have international investors as well. But on the other side of the coin, it's more about the settings. So we have some very accommodating settings for follow-on offerings. So for example, if you run a placement, you can place with institutions and sophisticated investors up to 15% of your share capital in any one year, and you can do so without shareholder approval, raise the money within 48 hours. So it's an extremely flexible, low doc offering method, and you can use that as a listed company on ASX. So for those 2 reasons, that really helps us become world leading in follow-on offerings. Another important aspect of being listed, of course, is liquidity. Now, driving liquidity is index inclusion. So if you get into the S&P ASX indices, that helps enormously in terms of having that passive investment, but also the active investment that is benchmarking those indices. Now, Australia has a much lower threshold to get into the major indices. So our blue chip index, the ASX 200, has an entry point, and this is US dollars for comparison reasons, of $730 million. The ASX 300, which is $372 million, is also a very well-tracked index in Australia. Now, the equivalent blue chip indices overseas have much higher thresholds. So you have to be a much larger company before you're attracting that investment. And so what we see in Australia is that you're getting access much earlier to that global investment. And that goes on to the second point here, which is we have a lot of international investment on ASX. So in terms of the overall institutional ownership, it's about 54% Australian, so domestic ownership of institutions, but the rest is from overseas. So about 25%, for example, comes from the United States. There's also a good balance between institutional retail investors. So it's about sort of 70% institutional investment, 30% retail across the market as a whole. We've got a good track record in most, or really all industry sectors. Resources is our most dominant in terms of market cap and number of listings. We've also got some very big banks listed, but we have a long tail of smaller companies that are emerging in all sectors, and an emerging technology sector as well. So we've got some really interesting sort of billion-dollar plus tech companies listed on ASX, and also a sort of world-class peer group of healthcare companies as well. So the market overall is about sort of $3 trillion in total. Now, if I just drill down a bit more into the resources sector as a whole. So resources, here we're showing metals and mining, and then energy on the other hand. The largest bulk of the resources sector by market cap on ASX is metals and mining, but we also have some decent and large companies in the energy sector, oil and gas sector as well. Overall, it's over 900 companies in this space, so plenty of options as an investor, a large menu of investment opportunities. Those key names, the larger companies listed, you'll be well aware of, so BHP obviously being the flagship company listed on ASX, but of course a long tail of smaller opportunities as well. And of those 900 companies, they actually are based or have operations in 96 different countries. So it really is truly a global industry listed on ASX. There's been some interesting new listings recently. We've had, even though IPOs have been a little quieter than usual, we've had some really interesting dual listings, either as a result of M&A or just looking for incremental access to investors on ASX. So Newmont acquired Newcrest and listed at the end of the last year. That's actually listed in the US, of course, as well. Arcadium Lithium, or Arcadium was basically Allchem and Livent combination. So it's a New York listed company, ASX listed company that combined together and dual listed on the US side and on ASX. And then we've had a couple of really interesting copper listings. So Capstone Copper listed in Canada, dual listed just last month. And then Metals Acquisition Corp as well, dual listed, and actually raised money at the same time. So effectively did another IPO in effect on ASX, even though it was already listed in New York first. And NexGen, you heard from just a couple of presentations ago, has been a very successful uranium listing over time, listed back in 2021. In terms of the performance, there'll be no surprise to you that the metals and mining sector has outperformed resources as a whole over the last 10 years. The last 10 years has been more challenging in the performance of fossil fuel stocks. And that just goes to the theme of this whole conference. So metals and mining, obviously a very high level, has outperformed resources as a whole, but resources has also, nevertheless, outperformed the broader index in Australia, so the ASX 200. And the top line there, which is quite a dramatic increase over the last 10 years, are gold stocks. And again, that obviously reflects the gold price over time. In terms of capital raise, we actually raise capital through the cycle. So if we combine secondary and capital raise and IPO capital raise, it's about 12.5 billion on average has been raised every single year for the last 10 years. So that's continuing to be quite strong. So even though, like I say, IPOs have been a little quiet, the secondary capital raisings are extremely important, of course, to grow existing listings. And there's been some good take-up of those placements, rights issues, and share purchase plans over that time. If I go a little bit more into metals and mining specifically, I think this is a really important slide. I wanted to just show you in context where ASX sits compared to other competing exchanges around the world. So if we look at those competing exchanges, I'll start with the sort of top section, which is like, what does the market look like right now? So just in metals and mining, over 770 listed companies. We've got the number one in terms of size, market cap globally of any exchange. And we're sort of head and shoulders above the rest in that sense. And actually even more so in terms of capital raising and IPO activity. So the section below is actually over the last 3 years what we've seen in IPOs and capital raisings. So you can see 185 IPOs in that period on ASX, just in metals and mining, which is way ahead of any other stock exchange globally in those 3 years. You can also see in terms of capital raise, this is US dollars again for comparison, about $2 billion in capital raise in just IPOs over that period. And so we're number one, both in terms of those IPOs, but also in terms of number and capital raised in follow-on offerings as well. So that's a really important slide. And quite honestly, I was a little surprised when we put this together, just how far ahead of the other exchanges we currently are. So that just bodes well, both in terms of, if you're thinking about listing as a company, it's a great place to list and raise capital, but also in terms of an investor, the menu of investment opportunities is very long and very wide. In terms of listed companies, we also support them post-listing, of course, as a stock exchange. That's really important. We run various programs for our listed companies in terms of investor engagement. And we also have sort of thought leadership pieces and education on various policy and rule changes over time, and run those sessions with our listed companies to help them keep ahead of the curve in terms of developments on that side as well. And then we also run an equity research scheme, which is subsidized research for smaller companies, for small cap companies, where we subsidize brokers to cover those stocks. And we found that over time, that's helped stimulate further research in those names. So to sum up, ASX has enormous tailwinds, and it is in a very privileged position to have a very large pension market that continues to support the equity market over time, and will continue to do so, increasingly so. We have the world's most significant and important metals and mining sector of any stock exchange, whether you're thinking about size or capital raising activity. And then finally, as I mentioned, for investors, it's really important because we have a continuing, expanding menu of investment opportunities in the sector as well. We expect that to accelerate as time moves on, as we go through the second half of this year, as I mentioned, and then into next calendar year. We have 4 members of the team at the conference, so please come and find us, and we're very happy to talk to you further. And if you'd like a copy of this presentation, we have the QR code right here, so please feel free to scan and have that at your fingertips. So with that, I'll close. Thank you very, very much for listening, and enjoy the rest of the conference.
That is a brilliant innovation to put that up at the end there too. Thank you very much. Appreciated that. All right, team. We're going to take a break. I'd say I've got on my program that we're coming back at 1 p.m. So you've got 45 minutes up your sleeve today to enjoy your lunch. But please make sure you come in and hear that presentation from Fortescue, because I think it will blow your mind, quite frankly, as to what they've managed to achieve. It'll certainly change the future for transporting our commodities around the globe. Enjoy, and we'll see you back soon. Thank you.